OK。
先生、女士们，我们很快就要开始，麻烦各位就坐。我们论坛很快就要开始了，先生、女士们，请尽快入座。
Good morning，
大家早上好，欢迎来到香港金管局国际清算银行的高层的论坛。我是 Karen Cole， 是今天的主持，我就代表金管局很欢迎大家，很高兴看到大家。我们庆祝金管局的30周年，还有国际清算银行25周年。我们今的论坛和包括一些即时的题目，比如说通胀啊、经济增长啊、稳定啊、就业等等，还有一些长远的发展，这些都会影响我们的金融系统，会影响我们的经济。我们会听取一些央行行长、现任的行长、优秀的人才。那么我们先让于伟文金管局的主席来给我们致辞。大家早上好，希望昨晚盛宴后休息好，大家都精神饱满，迎接今天的论坛。那么今天是一个很特别的聚会，是庆祝国际清算银行跟金管局的一些周年。在金管局，我们有3任的总裁，有任志刚、陈德霖，还有我自己。这国际清算银行那边呢，就有4代的代表，从 Bob、Zdaf、Ellie 还有张涛。所以是一个很特别的日子，我们有金管局、清算银行的代表们，就希望各位都能享受今天的一些内容。我们今天的主题是韧性、创新、转型、中央银行其他的愿景。大家知道过去几年比较波动，无论是疫情还是地缘政治、银行危机啊等等。但是我们在亚洲那方面，在过去多年来的韧性，就让我们比较顺利的过渡。同时间，我们也看到了一些趋势，一些有破坏性的趋势，比如说我们一些金融创新、气候改变等等，都带来不同的挑战。那么我们在思考未来的路向的时候，我们也发现，我们需要回顾才能往前看。那么在我们的今天论坛的安排里边呢，就考虑到这点。我们设计这个讨论的时候，就是参考了这些因素，所以我们邀请的讲员呢，除了央行行长啊、前任的行长，他们就协助我们回顾，还有展望未来，他们就会分享一些过去的经验，还有他们思考未来，还有无论是全球还是亚洲的路上，我们讲未来的时候也要记住合作的重要性。我们需要共同努力，跨越边界，跨越司法管辖区。所以，国际清算银行在这里扮演一个很重要的角色，它能协助 我们制定策略，还有协助央行之间的合作，就像我们今天这个论坛。我再一次预祝大家有一个成功的论坛，还有海外朋友们，我就希望你们在香港有一个愉快的经验。谢谢，谢谢于先生。那么我们今天呢，就有陈茂波先生，他是特区政府的财政司，有请陈先生。中央央行行长们 ，Carsten 先生、于先生、女士们，早上好！欢迎大家来到香港，亚洲的重要城市。大家来到这里，我相信大家亲眼会看到，香港在经历了3年的疫情，迅速的反弹，我们还是一个安全开放的一个对外开放的经济在我们这个秋高气爽的美好的天气香港特别的漂亮。在过去的时候，这个可能是冬季，这个气候改变是我们需要
address urgently. And this cameras the one country, two systems principle. We hold the common law system and the rule of law very dear to our heart. We treasure our international character that forms the fabric of the society and is the very foundation of our success. As an IFC, Hong Kong enjoys a close working relationship with the BIS. We have had the privilege of hosting BIS Asian office alongside its Innovation Hub Hong Kong Center since 1998. The history of Hong Kong's collaboration with the BIS is a testament to our shared goal of fostering international cooperation and safeguarding the stability of the global financial system. The quarter-century history of the BIS Asian office runs in parallel with a period of remarkable growth in this region. As we all know, it was not all smooth sail. The region has been through economic cycles, financial crises, pandemics, and occasionally social turbulences. From the Asian financial crisis in the late 1990s to the global financial crisis in 2008 and the market squeeze at the onset of the COVID pandemic, despite all these challenges, our economies and financial systems have continued to grow in size and sophistication, demonstrating resilience and adaptability along the way. Being Asia's key financial center and a small, open, and externally oriented economy, Hong Kong has been the epidemic center of many of the trials and tribulations that Asia has experienced. Yet, Hong Kong's financial system remains eminently safe and sound. Each time when we weather a storm, we emerge stronger and more resilient. The linked exchange rate system is a good example. Having gained experience from a bumpy road, we introduced various measures and refinements back in 1998 and 2005, respectively, and have formed a robust regime of convertibility undertakings. Of course, it is backed by a substantial reserve in the exchange fund amounting to over $400 billion, about 1.7 times of our monetary base. Let me assure you that the Hong Kong SAR government puts financial stability and security as one of our top priorities. Over the years, we have built up robust regulatory regime and strong buffers. We ensure our rules are high quality and consistent with international standards, and we have remained vigilant against emerging risks. In particular, in light of daunting challenges and changing circumstances, we have established a high-level cross-market coordinated round-the-clock monetary mechanism covering all sectors of the financial market, allowing us to detect if risks are looming. Naturally, given Hong Kong's role as the gateway to the Chinese mainland and the global offshore renminbi hub, the central authorities have given us unreserved support and backing in both regulation and development. One example is the renminbi 800 billion currency swap agreement with the PBOC, for which we have ample additional liquidity support in renminbi. On a wider perspective, the expanding and deepening connect schemes with the mainland, from products to derivatives, from institutional investors to individual investors, are boosting the liquidity and ecosystem of Hong Kong's financial markets. Ladies and gentlemen, as we gather here today, let us remind ourselves of the critical importance of cross-border collaboration. The financial sector is a global marketplace where capital moves across borders at awe-inspiring speed and volume. Such international capital flows bring enormous benefits, more funding for business, investment opportunities, and economic growth. But they also expose economies to potential shocks and vulnerabilities, from the Asian financial crisis to the recent turmoil in the relatively obscure corners of regional banks in the United States and a global bank in Europe. It means that crises can readily ripple through the global financial system, only now with an even greater speed. At all the episodes that I just mentioned, central banks and regulatory authorities have been swift to take coordinated policy actions to restore market confidence and stability. And once the pressure has eased, they also share lessons learned and implement globally consistent measures to address the vulnerabilities that were exposed. To this, I wish to express my sincere appreciation. But as we all know, finance is imminently adaptable. New and previously unimaginable risks emerge as financial sector reacts to new regulations and develops new products and services, many of which, such as virtual assets, are borderless in nature. Government and central banks must therefore continue to work together, share knowledge, intelligence, and coordinate policies to ensure the stability and resilience of the global financial system. Ladies and gentlemen, despite the proven benefits from international cooperation, deglobalization, decoupling, or de-risking pressure has emerged in recent years. Whatever guises that it may take, reshoring, friendshoring, or onshoring, severing cross-border linkages will hinder economic growth, limit access to global markets, disrupt established supply chains, and impede the flow of goods, services, and capital. Fragmentation of international financial market can lead to increased costs, reduced market liquidity, and ultimately a weakened global financial system. Moreover, deglobalization and decoupling could deepen economic imbalance and regional disparities, as countries may face reduced access to markets, investments, and technology. Such economic divisions could also potentially increase tensions and conflicts among regions. All these elements will potentially bring more sustained inflationary pressures across the group. The monetary environment will be more challenging. Fortunately, a full-blown decoupling now seems less likely to happen, given the temporary easing in geopolitical tensions and the highly interconnected nature of the global economy and financial system. Also, not all countries are moving down this competitive path either. Many economies, such as those in the Middle East and Europe, are diversifying their investments and strengthening their connections with economies in Asia. In recent years, Hong Kong has played a very active role in fostering such collaboration across regions. We are now seeing more enlightening results. The lessons learned from history, as well as the recent experience of the COVID pandemic, have demonstrated that we share one planet. At this very moment, we are also facing pressing challenges that demand collective efforts to overcome. Climate change is a prime example. The transition to a greener future is inherently a shared moral responsibility and has a chance of success only if we work together immediately. Another is technological advancement and artificial intelligence, which hold great promises, but could also fundamentally disrupt the way mankind works and lives. Regardless of our nationalities and affiliations, the efforts of everyone in this room are critical to addressing the challenges that lie ahead and to ensure that we benefit from rather than being overwhelmed by such technological developments. Ladies and gentlemen, by fostering dialogue, building trust, and working collaboratively, we can forge a path toward a more sustainable and resilient future. Today's conference is part of this bigger effort, and I wish you all a fruitful discussion today. Finally, may I extend my heartfelt congratulations to the BIS on its 25th anniversary of the Hong Kong office, in fact, Asian office. For so long, BIS has played an important role in promoting collaboration and dialogue among central banks in the region. You will continue to be a valued partner of Hong Kong. Thank you very much, ladies and gentlemen.
Thank you very much, Mr. Chan, for that address. I'd now like to welcome Mr. Augustin Carstens, General Manager, Bank for International Settlements, to the stage to say a few words. Please give him a warm welcome.
Dear Paul Chan, Financial Secretary of Hong Kong Special Administrative Region, dear friends and colleagues, let me start by congratulating Chief Executive Yu and the Hong Kong Monetary Authority for the 30th anniversary of their eminent institution and welcome all of you to this HKMA-BIS High-Level Conference. It's also a great joy to see Norman Chan, Joseph Yam, great partners for so many years. The trifecta of Norman, Joseph, and Eddie has been magnificent. We have been very fortunate to have such good partners. This event also marks an important occasion for the BIS. It is the 25th anniversary of the founding of our Asian Representative Office. Establishing a physical presence outside Europe was a significant step for the BIS. It signaled our evolution into a truly global institution that serves the entire central banking community. I would like to use my remarks to reflect on the journey we have taken to bring more of the Asia-Pacific region into the BIS and more of the BIS into the region. Starting the Asian Representative Office has been an eventful and rewarding enterprise for the BIS. But while it seems obvious today that the BIS needs to be in Asia, we should recall that 25 years ago, the case was not so clear-cut. When we founded the office in 1998, the region still bore the scars of the Asian financial crisis. Some wondered whether the regional economic miracle, which even then had lifted hundreds of millions of people out of poverty, had run its course. The region has certainly proved the skeptics wrong with impressive performance in the past 25 years. It has grown by an average of 5.5%, accounting for 2/3 of global growth over the time. As a result, Asia's share in the global economy has risen from around 30% in 1998 to over 45% today. The region is also home to 3 of the world's 5 largest economies: China, Japan, and India. Most importantly, Asia's strong economic performance has had a transformative impact on many of its inhabitants. GDP per person increased from less than $4,000 in 1998 to 18,000 today. And there are many other aspects that characterize Asia. One that I was surprised to learn just yesterday in a conference with some colleagues here is that 50% of the patents registered lately have come from Asia. So a real tribute of innovation. Catering to this dynamic and innovative region forced the BIS to change. Our banking services evolved, and our economists explore new topics with fresh perspectives. We also stepped up our innovation efforts by capitalizing on the vibrant fintech ecosystem in the region. It's suffice to say that 2 out of the 3 initial innovation hub centers were opened here in Asia. We're fortunate to have had a strong and committed partner in the HKMA working alongside us. So thanks you, Eddie, and your colleagues at the HKMA. I would also like to pay special tribute to the Asian Consultative Council, which was set up in 2001 and includes 13 BIS member central bank governors from the region. The Council has helped guide the BIS work in Asia and the Pacific and conveys the region's experiences and interests to the wider BIS membership. Looking back, 3 principles have governed our work in Asia and the Pacific. First, we have learned from the region. A concrete example of this was our work on the development of macro-financial stability frameworks, which was inspired in part by the successful steps regional central banks had taken to keep inflation low while preventing the buildup of financial imbalances and managing, at times, volatile global financial flows. In addition, analysis on several issues of importance, such as the revolution in digital finance, has enabled the BIS membership to better comprehend policy making in Asia and discuss possible lessons for other regions. Second, we have sought to serve the region. We have prioritized our customer needs and strengthened our role as a financial service provider by expanding our range of products, deepening green bond markets, as well as providing liquidity to regional central banks during times of stress. Third, we have grown alongside the region. Since establishing the Asian Representative Office in 1998, our operations, membership, and footprint have all grown. The number of BIS member central banks in the region has risen from 7 in 1998 to 13 today. Our own office is now almost 60 strong. We have established innovation hub centers in Hong Kong and Singapore. We have enhanced our outreach and engagement with our Asian constituencies, including by strengthening of existing and building of new partnerships, as well as knowledge sharing of developments around financial technology-related themes deemed to be of critical importance to the region's central banks, not least the development of CBDCs. And our regional members are playing a bigger role and more influential role within the BIS. For example, governors from the region chair 2 of our committee and meetings, the Committee of Global Financial Stability and our Emerging Market Economies meeting, chaired precisely by Eddie Yu. Looking back, there is much to be proud of. Looking forward, new challenges await us. At today's conference, we will hear about many of these challenges. They range from high inflation and heightened financial stability risks to ingrained structural headwinds to growth, including from global economic fragmentation, slow productivity growth, and demographic change. Each central bank will have to meet these tests in their own way. But in doing so, I think there is much that can be learned from the Asian experience of the past quarter century. In my view, several core strengths stand out. One is the criticality of fostering robust policy frameworks, and deploying them nimbly is critical. The relative success of many Asian central banks in combating high inflation in the aftermath of the pandemic was no accident. Their decades of work in building and strengthening macro-financial stability frameworks played a key role. In the wake of the Asian financial crisis, to ensure financial stability going forward, authorities in Asia had to experiment with many methods that were not necessarily part of the accepted wisdom of the time, including the importance of macroprudential policies to provide a counterweight to the financial cycle. Sustaining integration both within the region and with the rest of the world is another theme. Asia is one of the biggest beneficiaries of the existing multilateral system and among the strongest advocates for sustaining and strengthening such a system. The BIS, as one of the oldest global financial institutions, is ready and willing to be a strong partner for our Asian member central banks in such endeavors and in the provision of global and regional public goods. A final lesson is the value of riding the tides of innovation to build a more inclusive and resilient economy. Let me highlight the financial sector. Financial innovation and new technologies are changing both the landscape and the possibilities for central banking. Asia has been on the front line on much digital innovation in the past decade, including the development of digital identification and payment platforms that have brought hundreds of millions of individuals into the formal financial system in China and India. As I mentioned earlier, we at the BIS have worked closely with central banks in the region through the innovation hub centers we set up, including the two in Hong Kong and Singapore. We are doing our part. So let me conclude. We have witnessed remarkable achievements in Asia in the past few decades. The region has become richer, more innovative, and more resilient. That said, the region faces significant challenges on the horizon, some including slowing productivity growth, unfavorable demographics, climate change, and the green transition have already begun to bite. How to address these challenges now will determine how well we fare in the next few decades and beyond. We need to seize the opportunity and shape our future through collaboration, innovation, and investing in strong fundamentals, including in soft infrastructure. The BIS stands ready to be a strong and committed partner when you embark on the next legs of the journey, and this Hong Kong office will be a pillar in this pursuit. I hope that our discussions today may contribute to this end. Thank you very much.
Thank you. Thank you, Mr. Carstens. Mr. Carstens, can I ask you to also stay on stage at this end of the stage, because you were part of that very first discussion. If you would like to take the seat here, thank you. Ladies and gentlemen, our Financial Secretary, Paul Chan, has to leave us now due to other engagements, but let's have a round of applause to thank him for joining us this morning. Well, the global economy, as we've already heard and as we all know, is grappling with multiple challenges of inflation, financial stability, and growth not seen in decades. Inflationary pressure has proven more resilient than expected on the back of resilient labor markets and in an increasingly fragmented global economy. The higher for longer interest rate environment needed to combat inflation has exposed financial vulnerabilities built up over the last decade, and that poses risks to the growth outlook and to financial stability. So what are the policy trade-offs for central banks, and how can they best calibrate their policy tools in the period ahead to meet some of these global challenges? Well, we have several governors who will share their thinking about this with us in our first panel. Leading the panel, we thank again Mr. Augustin Carstens, General Manager of Bank for International Settlements. And I'd like to welcome our other panelists to the stage. They are Michelle Bullock, Governor of Reserve Bank of Australia, Pablo Hernandez Ducos, Governor of the Bank of Spain, Dave Ramsden, Deputy Governor of the Bank of England, and Governor Setaput from the Bank of Thailand. Please welcome them all. Thank you, Mr. Carstens.
Well, welcome all of you to this opening panel for this HKMA-BIS HighLevel Conference. Before proceeding further, I would like to remind you that this session is on the record and will be live streamed. We have definitely we definitely have a stellar panel today, really distinguished colleagues of mine. and I'm sure that we will have a really rich conversation today. The objective of this panel is to sort of set the stage for our further discussions, and in a way this has to do with basically assessing where the global economy is, and in that context where central banks are in the pursuit of a lower and stable inflation. Since 2020, we have faced a very convoluted world. Needless to say, COVID-19, huge shock that affected all aspects of society, including the tasks that are commended to central banks. If we recall where we were at the beginning of COVID, we were coming from a period of very low inflation. Many central banks, as a matter of fact, trying to bring inflation up to their targets, quite unusual state of affairs. COVID-19 hit. We decided, well, the humanity decided, as a way to combat COVID, to put the economic activity under animated suspension. I mean, it was decided that we needed to pretty much close the economies to combat the pandemic. Of course, that was a major aspect in affecting economic prospects as we move forward. That invited very aggressive macro policies, both in the fiscal and monetary side, because we were fearing a major depression. If you decide to close down all the economies, economic activity needlessly was going to suffer. The good news is that we had a relatively quick rebound. We have the vaccination. Economies came back strongly. And two things I would say at least combined to make our life difficult in inflation. First, to turn back on the economies is not as simple as turning on and off light. Many aspects of in value chains, productive activities were distorted, and that ended up affecting, generating dislocation, affecting growth, but also generating inflation. We also had a very quick recovery, and that meant that the stimulative programs, both on the monetary and fiscal side, turned out to be too expansionary. Then we had an additional shock, which was in commodities as a result of the Russian invasion to the Ukraine. Starting in 2021, we saw a very sharp increase in inflation, and the central banks, needless to say, acted quickly to try to bring inflation under control, bring it back to the 2% target. We know, or 2% or 3%, I mean, each country has its own target. We know that this process is lengthy. So far, after some months of very intense monetary tightening, I have to say that we have seen a pretty good progress. Pretty much all the transitory components have been worked out, and the core inflation still remains relatively high, but some progress is being made there. We're in an interesting moment in the monetary policy implementation, a very speedy increase in interest rates. Now the dilemma, the complexity that is always there is that you tighten monetary policy and the transmission mechanism is not immediate. So we're at the stage where in most latitudes the hiking interest rates have been substantial, and we still have to see what the impact on inflation will be. So we will have a 6 to 9 months period where we will see how sufficient has been the tightening that we have seen so far. Usually when you tighten, there are consequences on 3 important dimensions in the economy. First, employment and economic activity. Second, financial stability. Third, it has an impact also on debt and public finances. I would say in the 3 areas, effects have been felt. The economy has been slowing down. Employment hasn't been growing as much. But I have to say, at least in my own perception, according to our analysis, the impact has been less severe than what we anticipated. Nevertheless, the outlook is still a little bit weak as we move forward. Financial stability so far has been quite good. We had some hiccups at the beginning of this year, but they turned out to be idiosyncratic. But, you know, still the way is to go. In the next 9 months or so, we will see again a period of high. I mean, we still see an indefinite time of high interest rates, higher real rates, lower economic growth, so that also can have an impact on financial stability. And of course, public and corporate debt is high. Now with higher interest rates, this will also complicate matters. So there are many, many challenges. I would say so far we are on a good trajectory, but the way forward is not necessarily so smooth. In the future, we'll have less growth, probably some volatility, and of course, we central banks need to be really persistent in fighting inflation. So with this introduction, I would like now to turn to the panelists. We have I mean, everything has been timed to the second. So I would appreciate if in relatively 3 to 4 minutes, you can give us your thoughts of where you are in this process of disinflation. Obviously, you can accentuate whatever aspect you think is pertinent in your case. So, ladies first, so let me give the floor to Michelle. Please, Michelle, the floor is yours.
Thank you very much, Augustin. So I'll highlight a couple of things. The first is that, in some sense, our path of inflation has been very similar to that overseas. Inflation peaked at around about 8%. It's since come down over the last 9 months to be a bit over 5%, both in headline and core terms. Like overseas, a lot of that's been driven by declining goods price inflation, and what we're observing is that services price inflation is quite sticky. What we're forecasting is that inflation will come down to about 3.5% by the end of next year, and then a bit under 3% by the end of 2025. Now, for those of you who don't know, our inflation target is between 2% and 3%, and we sort of obviously would like to aim for about the middle of that band, but it's flexible in the sense that we've got a bit of a band. The thing I'd highlight, though, is that it is very uncertain. There are big ranges. Everyone's seen the fan charts that a lot of central banks produce, and ours are no different. There's a wide range of uncertainties and experiences there. And I'd have to say that we've been a little surprised on the upside recently in this sense. We've been surprised by a little bit on the strength of activity. It's held up a little better than we'd thought. That's meant that services price inflation has held up a bit more, so what we're observing is a bit more domestic price pressures than we'd expected. So that really is the challenge going forward. We have, like other countries, raised interest rates much more quickly than we have in the past, and that has created, in fact, a lot of political noise and a lot of noise from the general public. Australia, for those of you who don't know, has a predominantly floating rate mortgage system, and that means that interest rate rises flow through very quickly, and it flows through quickly to those who have mortgages, and that's around about 45% of the population do have a mortgage in some sense, either over their own home or in an investment property. And that's created a lot of noise. People are very unhappy. The cash flow channel works very quickly in Australia, and it's very prominent. But what I'd like to highlight here is, though, despite that noise, households and businesses in Australia are actually in a pretty good position. Their balance sheets are pretty good. Through the pandemic, they built up large buffers, large savings buffers, and they're largely still intact. Housing prices are rising again, much to everyone's surprise, so that's sort of helping people feel a little bit more wealthy. There were also very prudent lending standards through this period. So debt to income, high debt to income loans have a really small proportion of lending, as are high LVR lending. And there was an interest rate buffer imposed of around about 3%, so a debt serviceability buffer, if you like, of 3%. So there's been some good prudent lending going on here, and that's evidenced by low arrears rates so far. And those who are coming off very low fixed rate mortgages, they're managing quite well, and all the indications from the banks and all we hear from the banks is these households are doing fine. So actually, from a financial stability perspective, this all looks rather good. And I'd have to say, though, that employment is the key here. We still have, although the labour market has eased, it still is a pretty tight labour market. People are getting work, and that's really important for people being able to pay their mortgages. That said, there are distributional consequences, and we are dealing with the political economy challenges of the distributional issues associated with raising interest rates. So I think the challenge for us now is really to continue to make sure that we keep pressure on, make sure that we don't let inflation expectations get ahead. They're not at the moment. They are remaining relatively well anchored. But the challenge is to do that at the same time as we don't end up with a large increase in unemployment. Continued employment is really important. It's important for our dual mandate, obviously. We care about it. It's also important for people being able to continue to meet their mortgage repayments and their essential living expenses. So we're in a period now where we have to be a little bit careful. We want to make sure that we keep inflation under control and we bring it back down to our band, but we also need to make sure we do that in the context of not imposing on the economy too much and raising the unemployment rate so much. So that for us is our challenge. So thanks, Augustine.
Excellent. Thank you very much, Michelle. Now let me give the floor to Pablo.
Thank you very much, Agustin. I mean, from the perspective of the euro area and focusing on monetary policy, perhaps the question of where we are should be answered by this communication, this statement that we did already after our meeting in September, but we also repeated in October when we decided to keep rates unchanged, which is basically that our current assessment is that the current level of interest rates, if maintained for sufficiently long duration, might be sufficient to reach our target of 2% in the medium run. And this is an important statement because, in my view, it contains the three main elements of how we see, or at least how I see, the situation in the euro area. The first one is clearly that our forecast, the forecast that was produced by the staff in September, was anticipating a decline of inflation, a gradual decline of inflation towards our 2% target in 2025. And this was justified for several reasons. Some of them were mentioned by you, Agustin, in your initial remarks. Of course, the fact that a significant part, at least in the euro area, of the increase in inflation in 2022 was due to energy prices and food prices, and these energy prices and food prices have declined in a significant manner, and this is, of course, being transmitted and is expected to be transmitted to underlying inflation also in the following quarters. Of course, demand is weakening. Not only because, of course, the recovery after the pandemic has vanished, but also because of monetary policy transmission is affecting demand as expected, and is expected also to affect demand in the future. Fiscal policy, our expectation is that it might turn restrictive in 2024 and 2025, because, of course, as you can imagine, after the significant increase in deficits and debts after the pandemic, and well, hopefully with an agreement on the Stability and Growth Pact, there will be a need for many countries to enter into this restrictive territory in order to provide sound public finances in the future. So the reasons for, of course, the unwinding of supply bottlenecks is also an important factor. This is the first element that it is behind this statement. I think it's also important to emphasize that we've also gained a lot of confidence in our forecast. It is true that in 2022 our forecast errors were very significant and always surprising us, inflation on the upside. But it is also true that in the last 3 quarters, inflation has behaved in a very similar manner as the staff was projecting initially. And indeed, even for core inflation has evolved even better in terms of being lower than initially expected by the forecast. I think this is also important. The second element behind this statement is, of course, that behind these inflation projections are the financial conditions that were prevalent in September when the forecast was produced. And financial conditions today are not very different to those that were present in September, meaning that the market is indeed expecting us to be persistent in our current level of rates. So our statement, several members of the Governing Council saying that it is too premature to talk about rate cuts is, of course, also the view of the market. But at the same time, of course, at some point there is also some inversion of the rate increases in the expectation of the market. But to me, this is also a confidence given by the market that at some point we might be reaching our target. And of course, given that our current level of rates is in restrictive territory, we might come back at some point. We should come back at some point also to neutral level. But of course, this is not to be anticipated in the short run. And the third element that it is important to emphasize in this statement is the conditionality. This is a conditional statement, which is absolutely crucial in a context, as you were saying, Agustin, that uncertainty is very high. There are many risks in the horizon. For me, probably the most important one is the geopolitical risk, and in particular, those derived from the war in Middle East, to what extent this might be extended to other countries. This is not, of course, the expectation today, but this might happen. If in the end this happens, this would lead to a new negative supply shock, which, of course, for the euro area economy would be a new terms of trade shock, as the one that we had last year. And then the implications of this new negative shock to the economies are not obvious, and in particular for medium-term inflation. It was very clear last year that the negative supply shock in a context on which demand was recovering very quickly, on a context on which monetary policy was restrictive. Of course, the implication for inflation was that the fact, not only for the short run, but even for the medium run, was high inflation, and this is why monetary policy had to react in a very significant manner. But of course, now the context is completely different. Demand is weakening. We cannot even exclude the possibility of having negative numbers also for Q4 in the euro area. Of course, monetary policy now, as I was saying, is in restrictive territory. This means that potentially the implication of this negative supply shock on the medium run on inflation might be different to those that we were anticipating last year. But at the same time, if this negative supply shock materializes, then it will happen and after a context of very high inflation for several years. And therefore, also the likelihood of the anchoring of inflation expectations might be higher. and therefore also the implications for inflation in the medium run might also be more significant. So again, a lot of uncertainty, which again emphasizes the point that we are also emphasizing, which is the data dependency of our monetary policy in this context. Thank you.
Thank you very much, Pablo, for giving us this very complete view out of the Eurozone. Let's stay now in Europe, and let me give the floor to David. Please, David, the floor is yours.
Hi, and it's a great honour to be invited to speak on this panel. I'll also focus on monetary policy as we're in the middle of a financial policy committee round back at the Bank of England. UK inflation peaked at 11.1% a year ago, but it actually remained above 10% until this April, reflecting the cumulative impact of the two unprecedented global shocks that Agustin set out. And inflation initially worked through imported goods prices, energy and food prices. But since this April, UK inflation has started to fall back sharply as energy prices in particular have come down, and headline inflation was 4.6% in October. Core inflation was 5.7%. But it's fair to say that inflation has proved more persistent than successive MPC forecasts. And in our latest forecast, published at the beginning of November, inflation is projected to be back at our target by the end of 2025. But in the forecast we made a year ago, inflation was projected to be back at target much faster by the end of next year. Now, the main drivers of that persistence have come from the tightness of the labour market, both from lower supply of labour and higher demand. In turn, we've seen strength in pay growth, which was still over 7% in Q3, and this has driven services inflation, which has stayed very elevated at 6.6% in October. And in this way, UK inflation has become much more homegrown. Meanwhile, demand has been more resilient than we expected, supported by that fallback in energy prices as well as fiscal support and by the tightness of the labour market. Now, against this backdrop, the MPC has raised bank rate from a low of 0.1% 2 years ago to 5.25% now. And at our recent meetings, including at our latest meeting in November, where we maintained bank rate at 5.25%, we have focused on that persistence. And the MPC has also emphasised that we think monetary policy is in restrictive territory. Now, there are different ways of thinking about restrictiveness, but for me, the most straightforward explanation is to think of it as the impact policy is having on holding demand in the economy lower than it would otherwise be relative to supply. We think that just over half of the impact of the tightening we've done to date is still to come through. But this restrictive stance will contribute to headline inflation falling further. It's forecast to be below 4% by next March and down to 3% by the end of next year, and back at the 2% target by the end of 2025. But it is notable that it takes 2 years from where we are now to get inflation back to target. Now, in the MPC's latest forecast, GDP growth is actually projected to flatline through to the end of 2024, which reflects the impact of restrictive monetary policy. Now, as Michel and Pablo have set out, there remain many uncertainties, but I'm becoming more confident about the outlook. And based on those latest projections, we think that monetary policy is likely to need to be restrictive for an extended period of time. And we've communicated that it will need to be sufficiently restrictive for sufficiently long to get inflation back to the 2% target, which is in line with the remit we've been given. And financial markets have internalized that message from us and other central banks that policy rates are going to have to stay higher for longer relative to previous expectations. But one thing I find noteworthy is the volatility of rates markets and their sensitivity to data releases and other developments. And we've been seeing that in recent days and weeks. And markets, as always, are entitled to make and to change their assessment of the future. And it may be that their expectations are underpinned by a different view about prospects than policymakers. One thing that distinguishes our forecasts on the MPC from many others is the weakness of potential supply growth, or the speed limit at which the economy can grow on the demand side without pushing up inflation. For the UK, we're therefore projecting a challenging path for the economy, one of subdued growth, stubbornly high inflation, and some pickup in unemployment. However, as Eddie Hughes said at last night's dinner, monetary stability and financial stability are the foundations for sustainable growth, and we'll ensure that inflation does return sustainably to the 2% target in the medium term. And I'll stop there.
Thank you very much, David. Now let me give the floor to Setraput, please.
Thank you, Augustine. First, let me say I'm going to be constrained to what I can say, and I won't talk about the outlook because we have an MPC meeting coming up this week. In fact, it's tomorrow, and normally I would not be speaking anywhere or even traveling, but I could not miss the opportunity to come and wish Eddie happy 30th anniversary, because the HKMA and Eddie and his colleagues have been such wonderful partners for us all throughout with us at the Bank of Thailand. So let me offer by way of substitute a look back in terms of our inflation path and our policy response and what impact that's had on our financial conditions in Thailand. Headline inflation in Thailand peaked last year at 8%, almost 8% in August, and core peaked at about 3.2% in December. So we're in terms of inflation, we're actually among the highest in the region. But we experienced a fairly rapid disinflation. Inflation started to come down quite rapidly. It came back within our 1% to 3% target by about March in terms of headline. And the latest outturn in headline inflation in Thailand is actually negative now. The latest outturn was minus 0.3%. That figure is a bit misleading because it includes a bunch of government fuel and electricity subsidies. If you strip out that stuff, headline will be coming out at about plus 0.9, core running at about plus 0.7. So inflation has come down quite rapidly, and it's been in Thailand for a bunch of reasons that we can go into. That word that people want to avoid a lot, it was transitory. We didn't see that much persistence in terms of inflation. So our policy response as a result was more what we called gradual and measured. We didn't feel the need to do such aggressive rate hikes as some of our other countries have had to do. We tightened rates from 0.5% to 2.5% in 25 basis point increments. We felt that it was a gradual and measured response. The public and the borrowers did not feel that way, as I think many of you understand. But it has resulted in a moderate tightening overall in terms of financial conditions in Thailand. But again, in aggregate terms, fairly moderate. The pass-through this time in terms of rate tightening onto M rates was on the order of about 60-odd%, so a bit higher than in previous cycles. And we've seen a slowdown in credit growth as well. And also, but one thing that's helped to offset some of the tightening on the monetary side has been a depreciation of the exchange rate. In Thailand, I think as with many countries around the region, when the exchange rate depreciates, that tends to have a loosening impact on financial conditions. We don't have a whole lot of foreign debt, and we have obviously a lot of exporters and whatnot. So when the currency depreciates, the financial on net tends to lead to a loosening of financial conditions. So overall, in terms of the aggregate picture, in terms of financial conditions, have been one where I would say, again, a picture of moderate tightening. But that aggregate moderate tightening, I think, obscures a lot of differences. I mean, the impact has been very, very heterogeneous. So, for example, while in aggregate it's been relatively moderate, certain sectors, particularly with the SMEs, I think have seen much more tightening. We see that because SMEs in Thailand, as I'm sure across the region, they don't tend to have a lot of fixed rate long-term debt. A lot of their debt is short-term and floating rate, so they get hit a lot harder with these rate hikes that we put pass through, and also a lot of the targeted credit measures that we put in place during COVID, these targeted credit to help SMEs and whatnot, expired. And so the credit growth, which was actually positive during COVID, now has turned negative for SMEs. So the tightening impact has been fairly heterogeneous. In terms of the overall impact of this tightening and on the overall economy, latest outturn in terms of Q3 GDP was somewhat disappointing. It came out at 1.5% growth. But domestic consumption has held up quite substantially, quite well all throughout. Third quarter, private consumption grew at about 8%, and year to date it was like on the order of about 7+%. A lot of, again, in Thailand, our outlook and our recovery is very conditional what happens on tourism, similar also to in Hong Kong. And while we've seen a reasonable pickup in tourists in Thailand, with the exception of Chinese tourists who have not been coming back. One thing that's also noticeable is the spending is down. So that in terms of the tourists that come, but they're clearly spending less. The spending per trip is down, and it's down about, ballpark, about 75%. They're staying shorter, and they're spending less. So let me stop there.
Thank you very much, Sataput. Let me now focus a little bit more on very specific issues or more specific issues and allow our panelists to elaborate more on some topics. After this round, we will move to open the floor for Q&A from the audience. Again, let me start with you, Michelle. You had a very, I would say, interesting and I would say intense start as governor. You needed to tighten monetary policy immediately. I think that was, in a way, I mean, hopefully at the end it will be a blessing in disguise because you have established your strong commitment and determination in observing your objective. Now, the very specific question is, why do you think inflation has proven to be stickier in Australia than what we used to have in the past? Does this have to do with the transmission of interest rates to inflation?
So as I said earlier, I think it's about demand being a little bit stronger than we had anticipated, and certainly more than we had forecast. There's a few things going on here. I think we talk a lot about supply shocks and energy price shocks, and in Australia also we've had sort of rents going up and insurance. Now these are things that monetary policy can't necessarily do anything about, but I think it emphasises the potential importance of second round impacts. And I think what we've been observing is that some of these costs, along with wages haven't got completely out of control in Australia. They're running at about 4%. But without any productivity growth, that's actually resulting in a reasonable increase in unit labour costs in Australia. So what I think we're starting to observe is second round effects of some of these costs. Businesses are finding that demand is sufficient that they are able to pass those costs through. They therefore are maintaining their margins. And that's what's sort of meaning that services price inflation in particular is quite sticky. We do observe that people are, households and individuals are slowing their spending, some a little more than others. The evidence is that younger age groups are slowing their spending a little bit more than older age groups. Some of the things that are impacting on younger age groups, of course, are rents are rising very quickly in Australia, and this is quite a separate issue. It's to do with supply of housing. During the pandemic, we had an accelerated reduction in household size. This is something that's been happening for some time, but it accelerated somewhat, which has increased the demand for housing at the same time as supply hasn't really responded. So that's impacting particularly younger people, I think, and lower income people. So they're starting. So we are seeing discretionary spending come in, but it still seems that there is enough of it out there that it's meaning that businesses can maintain their margins. The other thing that's going on is that we've had very strong immigration in Australia. And even though we see consumption per person declining, in total, consumption has held up. It's not particularly strong, but nevertheless, it's strong enough. And I think that has also meant that demand has held up. The caveat I'd add to that is that at the same time as immigration has added to demand, it's also added to supply, because we've had a very tight labour market. And in fact, as we were coming out of the pandemic, that was one of the cries of businesses. They couldn't get labour, and they wanted immigration to get labour. So it just demonstrates, I think, that there's two sides to many of these stories. So while immigration has added to demand, it's also added to supply. It's added to supply for labour. So I think that's the reason why we're seeing services price inflation quite sticky in Australia. But again, we do think that monetary policy is restrictive, and that it is going to, and we're seeing it actually have a dampening impact on demand, and that will help.
Well, thank you very much. You really have shown tremendous nimbleness and flexibility, and that fares well for Australia in the future. Let me now go to Pablo again, but I will take advantage of the fact that he is the chairman of the Basel Committee on Bank Supervision. He gave us already a very complete view on Europe. I think it would be very interesting for this audience to hear your views of the challenges in the banking system, particularly from the point of view of financial stability, given that higher interest rates certainly mean more pressure on the financial system, in particular the banking system. So how do you see things? How are challenges? All in 3 to 5 minutes at the most.
Yeah, no, thank you very much, Agustin. The interesting thing about the Basel Committee, what I've learned in the last 5 years chairing the Basel Committee, and I have Arthur here, who is a very prominent member of the committee, is that there is always a mix in the analysis that we do of having a forward-looking perspective, always trying to scan the horizon, no, and to see where the risks are, but at the same time also trying to learn from the different experiences that we have. No? And to answer to your question, is probably you need, Agustin, probably a mix of the two. No? On the one hand, it's clear when you look at you look to the future that for sure the current environment of very significant increases in interest rates in a very short period of time, it has created for many banks high profitability. But we know that this is probably only a short run effect, that at some point credit risk might also materialize, and that there might be losses also in some of the assets. So this is why, from the perspective of the Basel Committee, we are sending the message that the banking sector should remain very prudent, and even you could even claim that they should use even the profitability, the high profitability that we are observing, in order to increase resilience, not even to keep resilience or to maintain resilience, but even to increase resilience. At the same time, many of the risks that we observe and that we identify for the banking sector are more structural, not so much conjunctural, and are derived from climate change or digitalization. And this is also the focus of the committee, and we are precisely now working very hard on trying to identify how to mitigate, from the perspective of the banks and from the supervisory and regulatory perspective, how to help the banks to internalize those risks. But this is the forward-looking perspective, but we have also to take into account the backward-looking perspective. And here let me mention at least 3 elements that for me are relevant. The first one is, of course, the lessons learned from the global financial crisis. Of course, many of the reforms that were identified have already been implemented, but it is also true that the last mile of this reform, which is Basel III, the one that was agreed in 2017, this has not been implemented in many jurisdictions. It has been implemented in Asia, mostly, and in full and in a timely manner, but this is not the case, for example, in two main jurisdictions such as the US and Europe. So the key message here for us is to still send the message that this is absolutely crucial, that this implementation is done and is done as soon as possible. Then second, when the pandemic came, we also tried to analyze the implications of this exogenous shock into the banking sector and to what extent the regulation and the supervision that we had worked as intended. And perhaps here, well, we produced a report that was published in 2022, but perhaps one message that for me was relevant is this idea of, well, some doubts about the usability of the capital buffers that the banks have been accumulating over time. And we introduced this idea, and some jurisdictions are going into this direction, of positive neutral countercyclical buffer that basically means that even if there are not financial stability risks that are emerging that would lead to jurisdictions to increase the countercyclical buffer, still it would make sense to have, when the output gap is zero, to have a positive neutral CCYB that in the end could be used and could be released if when risks materialize, in particular, for example, when exogenous shocks materialize. It's not that we are obliging the jurisdictions to go in this direction, but we are sending the message that this could be a good idea, and many jurisdictions are indeed doing so. And of course, the third element that it is important is, of course, the turmoil that took place in March. We have also analyzed this in a very deep manner. We have already published a few weeks ago a document, and here the two main messages that I would like to send is first that there is a need for a strong supervision, and there are several elements on how we are currently supervising the banks that we need to change or at least to strengthen. For me, perhaps the most important one is this analysis of the sustainability of the business models of the banks, something that has always been very relevant, but with all these structural changes taking place and affecting the banking sector, the supervisors to also have a very prominent role in this analysis, I think is important. It's not only important to do the analysis, but also once that you reach a conclusion and you identify an outlier bank, also to force the bank to do what you want to do. And here, of course, is a tricky issue because, of course, you want to do it without co-owning the bank, no? And the tools that many supervisors have in order to force the bank to do what they want to be done is not always there. And then, of course, there are some issues on regulation that we need to analyze more deeper. And here is, of course, interest rate risk in the banking book, is liquidity risk. This is probably the most novel one because, well, the speed in the velocity of the outflows of deposits has surprised us, and this is a material change for the banking sector, and we need to analyze how to deal with this in the future. But it is also about the definition of capital, this issue of AT1s and to what extent they are playing the role that was intended when this instrument was introduced, or even the scope of implementation of Basel III. As you perfectly know, Basel is expected to be applied only to international active banks. Well, the reality is that, I mean, these banks that fail in the US didn't have an international role in terms of their activities, but still they created a significant contagious in other markets. So maybe we have to also to think about whether this definition or this scope of implementation of the current regulation is the right one. Thank you.
Thank you very much, Pablo. Very complete answer. Let me now go back to you, David. Certainly, the Bank of England has taken very decisive action to help inflation subside significantly. You have been using also actively QT on top of raising bank rate. What has been the experience? Do you think this represents or adds to the flexibility in adjusting policy? And, you know, do you think that this has raised any issues related to financial stability and market volatility?
Thanks for that question, because it enables me to talk about something that we've been carrying on in the background, as it were, in terms of our monetary policy actions. We first actually set out our strategy on QT back in August 2021, and very much focused on three principles, all designed to keep QT operating, but operating in the background, as I said. So first of all, we very much see bank rate as the active policy tool when we're adjusting the stance of monetary policy. Second, we really try and ensure that the sales that we do are conducted so as not to disrupt the functioning of financial markets. And third, to help achieve that, we take a very deliberate approach and conduct those sales in a gradual and predictable manner over a sustained period of time. And I think from what I was saying in my first intervention, you can see the contrast with our approach to bank rate. And really our preference for using bank rate in most circumstances is primarily because there's greater certainty. We've got a long experience of using bank rate. We understand how it affects the economy compared with these other policy tools. It's also operationally easier and quicker to implement. But although QT is designed to operate in the background, it does have a really important benefit of reducing the ratchet upwards in the size of our balance sheet over time. And you know, as we've seen over many years, being at the effective lower bound on interest rates, we've ended up at the bank, as many central banks have, with a very large balance sheet. And so by reducing that, we increase the headroom and flexibility for us to use the balance sheet in future, both in pursuit of our monetary, but also our financial stability remits. Now, in practice, we have followed the deliberative approach that I set out in terms of our principles. We actually commenced QT back in February 2022, initially through maturities, but we have a relatively high average maturity in our portfolio. And as of September 2022, the MPC voted to reduce the stock of gilts that we hold in a separate asset purchase facility through a combination of maturities, but also sales, initially by 80 billion. And then this September, we increased that reduction in the stock to 100 billion pounds. And that will take the size of the APF by next September down to a total of 658 billion pounds. And that compares with a peak of 895 billion in December 2021. So that's quite a fall. Now, gilt yields have, of course, risen over the period since we started doing QT, but the vast majority of the 300 basis point increase in, say, the 10-year gilt yield has been driven by increases in expected policy rates. We use a range of models produced by our staff that do suggest that changes in term premia have contributed to the more recent moves in long-term global yields. And QT may, of course, be one contributing factor there. For example, any portfolio balance channel of QT would be expected to show up in the term premia. But we're confident that QT is very unlikely to be the main driver of those increases in term premia. So the evidence we have to date supports our expectation that QT impacts, while greater than zero, are materially smaller than the effects of QE were on average. So we would estimate that the additional 80 billion of QT relative to a counterfactual is likely to increase 10-year gilt yields by less than 10 basis points in prevailing market conditions. And remember that principle of when we would actually do the QT. And that would map across into an impact on activity and inflation of less than 0.2% and 0.1% respectively. And so while there may be some QT impacts coming through, and this is an important point, the MPC can observe those effects on asset prices because they should be priced in to markets given our approach, and we can condition our forecasts accordingly, and therefore we do have the flexibility to adjust our active tool to the extent that any complementary or offsetting action is deemed necessary. So I wouldn't say there's any indication that it's made it harder to calibrate the monetary tightening, and I think we do have that flexibility of two tools. And we haven't seen, to your final point, Agustin, we haven't seen any financial market stability concerns emerge. And that's supported by very close quantitative and qualitative market monitoring that we undertake. We do event studies around QT auctions, and these point to very limited impact from the specific sales that we're doing. And we've also observed very little impact of unwind on market functioning. Indeed, there's actually been some signs of a positive effect by alleviating collateral scarcity at the shorter maturities that we're selling back into the market. A final comment, so I wouldn't see any financial stability grounds for adjusting our approach to QT or indeed to our setting of the level of interest rates as I was discussing earlier. And I'll stop there.
Thank you very much, David, for this very good answer, and it really enlightened us about how to use these two instruments together. Let me now turn to Sethaput. Certainly Thailand is in a different position than many other economies as inflation is more or less on target. Is the difference in inflationary conditions between Thailand and advanced economies creating any challenges for your implementation of monetary policy, for example, through its effect on capital flows and the exchange rate?
Yeah, we've seen a step increase in volatility in exchange rates from pre-COVID. Pre-COVID exchange rate, the baht dollar rate volatility was about 3-4%. Recently, it's been tracking closer to 8-9%, and typically we're like a bit more volatile than the other kind of ASEAN neighbors, but lower than that of, say, Korea and Japan. But now we're getting closer to Korean levels. I know Chang Yong is here. Happy to follow in his footsteps in many things, but not in this regard. And I think there are a bunch of reasons for that. A lot of the volatility has obviously been driven by uncertainty about what's been going on with the major economies' policy decisions, but that doesn't explain why we are relatively more volatile than other countries as well. And there are a couple of reasons in the case of Thailand, which are kind of more Thai idiosyncratic. We're also very correlated with yuan, because Thailand is seen as being very tied to China's fortunes in terms of tourism and exports and whatnot. And also Thai people like to buy and sell gold, so we've been very highly correlated, much more so than other Asian currencies with the price of gold, and that's been contributing to our volatility as well. Not to mention, obviously, this year we experienced a fair amount of both political and policy uncertainty. So those things have been contributing to our exchange rate volatility. The good news is that I think it's relatively manageable for us still, and largely going to do with initial conditions have been quite favorable. We have, again, good buffers, good level of international reserves, certainly relative to our external debt. Current account position should swing back into surplus. So on the external vulnerability front, we're relatively okay and in a pretty decent position to handle the volatility. Non-resident participation in our equity and bond markets is relatively low compared to other countries in the region as well. That said, I think it's important not to be too sanguine. One of the things that's probably contributing to kind of step increase in volatility in exchange rate is the fact that our rates are ending up lower than the U.S. And looks like it will be that way. I think for not just in Thailand, but I think for a lot of emerging markets in Asia, which I think is something we haven't seen before. And I think we're entering a period of a kind of uncharted territory. We don't have really good long historical precedent of a situation where interest rates in emerging markets, particularly in Asia, are significantly lower, and will look like they're going to stay that way compared to advanced economies, and that I think presages some challenges on the exchange rate and capital flow front.
Thank you very much, Sazaput. Well, we have had a really brilliant set of interventions, giving you a very full description of how the challenges are manifesting themselves in different central banks. We have been a little bit late, but I think we can take a little bit of time of the coffee break, and we probably could entertain a couple of questions if there is anybody who would really want to make a question. Yes, please. There.
Perhaps I can ask a question regarding QT. So currently, in the current environment, there are, some of the developed economies have a very high fiscal deficit. So there will be a lot more supply of bonds that will come to the market. It may or may not drain some of the liquidity. And how do you think about QT in that type of context?
David?
I think it's fair to say, from a Bank of England perspective, that we are conscious of the issuance that's going to be taking place from a range of advanced economies, including from within the UK, and we had our own fiscal announcement last week. But the way we think about it is that what we should be doing with our quantitative tightening is to follow the principles that I set out. So if we follow those principles, and so far, as I tried to set out, I think we've achieved that. There may be some additional impact on term premium alongside the impact you would get from issuance, but we think that, and I gave the estimates in my earlier intervention, that's really relatively small, about 10 basis points for, say, 80 billion of QT. So that is an additional factor to take account of, but as long as we take this deliberate approach, go about QT in a gradual and predictable way, don't do QT, for example, when there is very adverse market functioning, and we haven't seen that actually since we started the active sales late last year. We can continue with our program and meet our objectives alongside whatever's happening on the issuance front. Thank you.
Thank you very much, Dave. Let me ask this last question. Making use of technology, we received some questions here. I'm just choosing the very first one, first come, first serve. And it's a very broad and interesting question. The question is pretty much, we have come from a period of very low interest rates, very low for long. That certainly affected the borrowing attitude of corporations and governments. now that we're moving to a period of higher for longer, what is your assessment, according to your experience and your circumstances? How will this affect economic activity and financial stability? Of course, this question could really benefit from a whole conference in itself. But let me ask our very skilled panelists to try to give an impression in a matter of 1 or 2 minutes. Let me start with you, Michelle.
Just speaking from Australia's perspective, I mentioned earlier about notwithstanding the period of very low interest rates and the increase in borrowing, the Australian household and business balance sheets are actually in pretty good shape. So I'm not actually particularly concerned from a financial stability perspective about that. The other thing from the government perspective is that yes, we have had an increase in borrowing. Our debt levels are not really at about 35% of GDP. They're not really high. And one thing that we have benefited from, of course, is high commodity prices, and that's been of benefit to the government budget. And in fact, the government has a surplus this year, quite a good surplus, and they have banked the revenues. So I think in our case, I'm not particularly concerned about the particular balance sheet implications. Having said that, it's true that one of the major expenses for the government going forward is their borrowing costs, and that's going to continue to weigh on the budget.
Thank you very much. Pablo?
Yeah, very much along the same lines. For me, the main concern is the combination of this, high for longer. It's obvious, no, when you look at the 10-year rates, that they are significantly higher than the ones that the market were expecting in 2019, so before the pandemic. It's the combination of this with the fact, of course, that we are not expecting higher growth with these higher rates. So meaning that R minus G is probably now higher, and of course the implications for fiscal sustainability are obvious. And this is why, in this context, and after, of course, as I was mentioning before, and the significant increase in public debt levels in many countries, it's absolutely crucial to take fiscal consolidation seriously in order to guarantee the soundness of public finances, and to avoid also financial stability implications, negative financial stability implications coming from these debt levels.
Thank you, Pablo. Dave, I'm sorry.
Very similar position, I think, to that Michelle and Pablo have set out. I mean, a couple of points that that really resonated. Household and business balance sheets in the UK are also looking resilient. Something that Pablo said in his previous intervention, I think it's really important to track the impact of higher for longer on banks' business models. You know, in the UK, we capitalise for interest rate risk on the bank's balance sheets, but also we're very focused on what's happening in non-bank financial institutions. The only thing I'd add on borrowing costs is I think it really, one thing that, and many of you will be aware of this, we had an issue last autumn, early autumn, when we had a very rapid increase in long-term yields that was seen as in part driven by a fiscal policy approach that the markets didn't perceive as being credible, and that because that included the fact that our fiscal council, the Office for Budget Responsibility, was not involved in putting together the forecasts that underpinned the fiscal announcements. And I think that really does underpin a period when you are seeing likelihood of interest rates higher for longer, the importance of institutions and the importance of transparency. And so being able to absolutely track what's happening to the borrowing costs of government or indeed the borrowing costs of household and businesses, it's really important, I think, that markets see that you're being completely transparent in the way you're presenting those developments. And I'll stop there.
Thank you very much, Dave. Setaput, please.
Yeah, the area that worries us most would be household debt. Household balance sheets are going into COVID or somewhat weak in Thailand. Household debt to GDP peaked at about 95%. Now it's down to about 90%. But again, we've had inflation, and even though inflation has come down, the level of prices have increased. So the cost of living has gone up. So balance sheets are under pressure that way. And household debt is something that's very difficult to move. I think that by nature, the legacy debt, it's just very, very slow moving, hard to get down. And tackling it is very challenging from a political economy standpoint. You have to do a lot of unpopular things, right? I mean, the kind of things that we would like to do to try to address that would be, higher rates, tighter prudential stuff. All that stuff is not terribly popular. So it makes it that much more difficult to handle.
Well, thank you very much, Setaput. I will not try to summarize the discussion. Let me just say that we have witnessed very determined central banks having very clear in their minds where are they traveling and how are they doing. I think it's very reassuring, their commitment to bring inflation under control and at the same time being very mindful about financial stability and employment issues. So let me ask you to join me giving a round of applause to our panelists. Thank you very much.
Thank you very much, Mr. Carstens, for leading that discussion. Could I ask our panel and Mr. Carstens to come forward and stand together for a group photo before you leave the stage? Wonderful. Thank you very much. So we do have a slightly shorter break for coffee, but we will be back here for the next session at 11 o'clock. Coffee and refreshments are served outside. Please, if you leave the room, have a bit of bounce in your step so you can be back here for us to start the next session at 11. Thank you very much. Hello again, everyone. This is just your 1-minute call to please come back into the room and take a seat so that we can begin our next session. I know the break was a little bit short, but please feel free to bring your coffee, tea, and refreshments with you. And please come back into the room and take your seats again so we can start very, very soon. Thank you very much, ladies and gentlemen. Ladies and gentlemen, welcome back. If you are still coming into the room, please kindly come in and take your seats as our panel is already ready and we are ready to begin. Thank you, ladies and gentlemen. We are ready to start our next panel. Financial innovation in the past decade, as we know, has dramatically reshaped monetary systems across the globe, but it's also brought challenges to policymakers. So in this rapidly changing landscape, central banks play a critical role in promoting innovation while safeguarding financial stability. What are the merits and downsides of these technological advancements, the challenges involved in their development, and the associated risks and central banks' role in managing them, as well as key considerations involved for crafting an appropriate regulatory framework? Well, our panel here is about to discuss all that. Please give a warm welcome to our moderator, Mr. Eddie Yue, Chief Executive of the Hong Kong Monetary Authority, and our panelists, Mr. Ravi Menon, Managing Director, Monetary Authority of Singapore, M. Rajeshwar Rao, Deputy Governor, Reserve Bank of India, and Mr. Eric Tedien, Governor Sveriges Riksbank. Thank you, gentlemen.
Thank you, Karen. Welcome to this second panel about the future of the monetary system. And today we are very privileged to have three very good central bank experts about digital money. Ravi is a household name in Asia. You all know him. And Rajeshwar is from India with very good innovation in CBDCs. And Eric, of course, in Sweden, we are seeing the first CBDC pilot back 5-6 years ago. And we are seeing a lot of financial innovations that might actually shape the future money and finance and payments in a different way. Different disruptions. I think the two most important ones probably are blockchain innovation and AI. But let's put AI aside. Otherwise, just generative AI, we will spend the whole hour talking about it. But blockchain innovation is already a very fertile area. If you look at the past few years, the blockchain has brought about the rise of the digital asset ecosystem, the stable coins, CBDCs, where many central banks are piloting, including many of us here. The HKMA is doing both wholesale and retail pilots. And also increasingly, more people are talking about asset tokenization and deposit tokenization. So I would like to really ask each panelist on how all these changes will be shaping the monetary system in the next 3-5 years. Let me start with Ravi. In the MAS, under Ravi's leadership, you've been really spearheading on innovation in the past few years. And you've been having a very vibrant digital asset ecosystem. You're about to have a legislation on stable coins, and you've been partnering with different banks on tokenized asset and tokenized deposits. And with all these different new elements in finance, how do you, can you really just set the scene for us? How do you see all these integrating together in future? And how do all these new elements interact with traditional finance? Why don't you set the scene for us to give us an overview of where you see things are going with the trends that we are already seeing now?
Okay, well, thank you, Eddie. And thanks to, of course, to Eddie and to the staff and management of the HKMA for the wonderful arrangements. Great to be back here in Hong Kong after some time now, and to see the vibrancy and vitality of this city, which really symbolizes Asia as a whole. And I think the topic for today is well chosen. And as you correctly point out, I think the two big technological waves that are transforming financial services, one is digital assets and tokenization, and two is artificial intelligence. Maybe next year's conference we'll talk about AI. Tokenization and digital assets. Now, it's a very complex landscape. And I thought maybe if we just step back to see what is it that is at the heart of this movement. I would say it is the idea of tokenization. Even before we talk about CBDCs and everything else, is the idea of tokenization, which is in some ways akin to securitization about 50 years ago. And the central idea in tokenization is that you can take any asset, a real asset or a financial asset, express it as a token, as a digital token that you can put on a ledger, a distributed ledger. And what is unique about tokenization is that the ownership rights over that asset are embedded in that token, right? The token carries the ownership rights with it. And tokenization enables two things to happen. One is that it allows for direct exchange, or what those practitioners would call atomic settlement or real-time settlement. It allows for the direct exchange of two assets because they are both in token form, and you can put both on the same system, which is not the case today, right? You buy a security, you send cash or money. It's on two separate systems, two reconciliations, and if it's cross-border, it's multiple reconciliations. When you tokenize something, it is on a common, and place it on a common ledger, you can move assets seamlessly. So that's one big benefit. The second, it allows fractionalization. Here it's a bit akin to securitization. You can take almost any asset and fractionalize it into tokens. And this means two things. One, a much larger body of investors can have access to that asset. And two, the asset owner himself is now able to monetize it because he's able to fractionalize it and make it liquid and investable. So these are amazing properties, right? Now, how do you harness their benefits? And that's why I think the big wave, as you say, is the tokenization of financial assets and financial transactions riding on these two technologies, tokenization on a blockchain or distributed ledger. So if we want to tokenize assets and move them across these ledgers for seamless execution, then you need a medium of exchange. And this brings us to the topic at hand, which is the monetary system. And here I would posit that in its essence, the future monetary system is not going to look very different from the current one. As the BIS puts it, it will be still a two-tier monetary system. Today, the money system we have, or money, composes of two things: a central bank liability, which is notes and coins, and a commercial bank liability, which is the bank deposits we hold. For most of us, I think 95% of our money is in bank deposits, and maybe about 5% in loose cash in our pockets. That basic two-tier system is unlikely to change. But what is likely to change is that they will get tokenized, or at least part of that monetary system gets tokenized, so that that tokenized money performs a medium of exchange function in a tokenized financial system to move tokenized assets. So I think there are 4 contenders for tokenized money. One, central bank digital currencies, CBDCs, which is the tokenized form of notes and coins, as well as central bank reserves with the commercial banks. If you think of your monetary base, it's got 2 parts, notes and coins, and central bank reserves with the commercial banks. That's the foundation of the monetary system. So in a tokenized future, you will have CBDCs held as wholesale CBDCs with the banks, and perhaps retail CBDCs issued to the general public, which India and China have already done. So that is one form of tokenized money. The second, I think, would be tokenized bank liabilities, since more than 95% of our money is basically bank deposits. And when we make digital payments, we are moving bank deposits from one account to another account. In a tokenized economy, you will tokenize part of your deposits so that you can actually put it on the ledger, on chain, and finance and lubricate the movement of assets in the blockchain or distributed ledger. So I think that is a very viable candidate, and already there are many pilots being done, and we can get into some of those pilots, and many banks around here have already done this. It's gone beyond pilot, it's in production stage, but it's not scaled yet, and we could come back to that later. The third contender, and I know this is not universally accepted, are well-regulated stablecoins that keep stability of value. I know stablecoins have gotten a bad name in the last few years. Most of them are infamous for not being stable. And one wishes we could control the use of the word stablecoin. But I think if you can have stability of value, these stablecoins, which are issued by non-bank players, can be a very useful complementary form of digital money in the system that I just described. CBDCs, tokenized bank liabilities, and well-regulated stablecoins. Bank deposits are fractionally reserved. And as Cho Seah-Chuan mentioned yesterday, we trust bank deposits as money because of regulation, capital requirements, liquidity buffers, lender of last resort by the central bank. So we trust our bank deposits as money. Now, stablecoins don't enjoy those because they're non-bank issued. But instead, what I think regulators are doing is to move towards full backing. Basically, it's narrow money. It's narrow money. The stablecoin that's issued is fully backed by high-quality government securities or cash. So it's fully backed. The beauty is that it's in token form, and it can be used for a variety of innovative applications. And we can leverage off the innovations in the non-bank sector for the benefits of stablecoins. The last contender is private cryptocurrencies, bitcoins and the like, which I think have miserably failed the test of money because they can't keep value. Most of their traction is as a means for speculation. Nobody keeps their life savings in these things. People buy and sell these things to make a quick buck. I don't think it meets the test of money. So private cryptocurrencies, which are native digital tokens, unfortunately don't meet that test. So I think that they will eventually leave the scene, leaving these three components, CBDCs, tokenized bank liabilities, and well-regulated stablecoins as the three prongs of a future monetary system. I'll stop here, thanks.
Thank you, Ravi. I totally agree that tokenization will be a trend that we will see in the next 3-5 years. And we will come back to tokenized assets later. But let's focus on tokenization of central bank money, which is central bank digital currency. Let me go to Eric first. I know that Riksbank already started a e-krona project back in 2017, and you've been continuing the pilots through the last few years. What's your latest findings on your e-krona project? What's the next step? And also, I understand that Sweden has already gone very digital in terms of the payments. And I just want to ask you one question that's bothering all of us in thinking about retail CBDC, is there really a use case that e-krona, for example, can outcompete the current digital payments, that something that they cannot do, that we need to think about a retail CBDC or e-krona in your case? Eric?
So thank you very much, Eddie, and let's start with an anecdote. I think this was probably 3 or 4 years ago. I took the cab to the airport and flying down to Frankfurt, and the cab of course said a credit card only. So that's I'm used to. And then I landed in Frankfurt, and they say cash only in the taxi in Frankfurt. And I'm saying that because sitting here in Hong Kong, in Asia, it seems like the Swedish experience is very close to many countries here in Asia, extremely digitalized. Many countries, including, I think, China, don't use cash as much. But if you go to Europe, cash is still the predominant means of payment in the larger economies in continental Europe. So here, for sure, the Nordic countries stands out. So I never use cash. My kids don't know how a cash note looks like, which actually is a pity because eventually I will have my signature on one of them. But I guess I need to have it on on a wallpaper or something to just show that actually my sign. No, seriously, the CDBC project for sure started in Sweden many years ago, and I think what we have done so far is experimented the technical kind of issues. And I think and I'm pretty new to this job, when I talk to the people that have been working with this, say that the technical aspects seem to be manageable. So basically, it is possible in our test environment anyway, to integrate the CDBC into the bank system. It's also possible to integrate the CDBC into the terminals of sales in the retail part of it. So there, I think there's for sure a kind of a possible way forward. What we also try to explore, which I think is important both for integrity reasons but also for resilience, is the offline. And there we find more difficult. It's actually difficult to find totally with full integrity, so to say. Eventually it will be possible one way or the other to track down who did what payment. And of course, for many people, I guess including myself, that is a drawback with digital payment, that you don't have that integrity. So about this million-dollar question, no, I think this is a paradox that we are so digitalized, so it will be a hard sell to introduce something new, and the selling point is the fact that you have central bank money rather than private money. Well, that might be extremely interesting in a conference like this, but for the general public that make payments, they don't care, as long as they trust private money. Of course, that's the key here. We also have, since 4 or 5 years, it's more or less exploded the mobile pay. So that's now overtaking credit cards. So basically, we swish. And it's called swish because they have this sound when you do it on the phone, and swish. So that's why it's called swish. So that's a saying in my country, that you switch each other. Typically, you switch your kids because they know exactly how this works. So they can get money through swish. But this has gone from small payments person to person to actually even larger payments in the capital goods market, and even some business to business. So really an explosive development. But coming back to the possibility to have CDBC, it took like 30, 40 years to have cards being accepted and basically turning that tipping point to be a means of payment for everyone. For the Swish or for the mobile pay, it took some 10, 12 years. Even though I think it was a really good selling case, really good features. So I guess we are kind of skeptical that CDBC actually will have a big turnout, but I think still there are some advantages. And let me say a few words on why we're still exploring this. Of course, one is the anchoring of private money. So you could say that you have cash as the anchor today, but of course that's more or less an illusion because you can't take all deposit out of cash. That would be physically impossible. But just the mere fact that there is some mirror kind of money that is central bank money, i.e. cash. I think that anchoring, I sometimes call that as a philosophical question. Either you believe it or not believe it, but I think it's hard to reject. There is something in that. There is actually some kind of link to central bank balance sheet. So that's one thing. The other thing I think is the risk with with the digitalization is that you have a monopolistic kind of system. Basically, this is going to be run on one or two system or maybe banks jointly. To have an alternative, if that doesn't work out, I think it's of course extremely important, generally important, but also important for resilience. And resilience has turned out to be even more important, I guess, globally, but for sure in our countries. We are pretty close to Russia, and we should not talk about geopolitical things, but of course that's an issue that we feel actually that the geopolitical situation is not only something you read about in the newspaper, it's actually a clear and present danger. in our part of the world. And that we are stepping out on all aspects of the society, the resilience part of it, and for sure I think to have a resilient payment system is important. And on that, I will have another anecdote. I talked to my Ukraine colleagues, the Central Bank of Ukraine, and asked what happened in Ukraine when the war broke out. You maybe think that they were rushing to get more cash. And I think they did so initially. But eventually, actually, cash usage is going down and internet payment is going up. Because the internet is working fine, and of course to travel with a lot of cash in a war zone has a lot of complications. So that's just it might not be cash that is the resilient, might be something other, and to build a resilient payment system is important. I will close to say a little bit what's the future kind of strategy for a small open economy neighboring a large currency area, the euro area. So basically we are saying we should be prepared and go potentially jointly with Euroland, but not go first. Because from stability point of view and also from, as I think, a tactical point of view, it's probably better to follow and to see what happens there and to maybe do something when we see how they progress. But that means that we work closely with ECB. We also have a strong voice, I think, in the international community. So we want to be prepared. So that's basically the strategy. Thank you.
Thank you, Eric. Going back to your anecdotes about the taxi at the airport, unfortunately, the taxis at the airport in Hong Kong, generally, they don't take credit cards. They take cash. We've been trying very hard to push them to use digital payments. We will try harder after hearing your anecdote. Let me go to Rajeshwar. India is actually very, very quick and also quite progressive in introducing CBDC. I understand that you do it both on the wholesale and retail level. For the retail CBDC, I was checking that you've got already over 1 million users, and it's also connected to your instant payment system, which jacks up the usage rate. And wholesale CBDC, you're already using that for government bond transactions. So you seem to be really quite ahead of the rest of us. Can you tell us, what prompts you to push CBDC? What's your experience so far with the introduction of digital currency in India?
Thank you, Eddie. At the first outset, let me congratulate you and the BIS for completing 30 and 25 years. Thank you. It's great and nice to be in this conference. Regarding your question on the thing, if you look at it in India, the Digital Payment Index, which reflects the usage of digital means for financial transactions, has increased quite significantly. When we created a Digital Payment Index sometime in 18 with March 18 as the base, today in March 23, the number is around 395. That means there has been a fourfold increase in the last 5 years. So it's grown significantly. We launched the CBDC retail program with a closed user group sometime in December 22. And it's basically a digital representation of the physical currency. It began initially as a pilot with 4 banks and 4 cities. Now it's extended to about 13 banks and about 80 locations. And initially, basically a person-to-person and a person-to-merchant set of transactions. Right now, we have more than 2.75 million participants in the pilot. And the scope of the pilot is being gradually expanded to cover various use cases, designs, and technological considerations, so that we get a full-scale experience before we think of perhaps going further on this. And the experience from our previous implementations suggests that CBDC, like the earlier payment innovations, etc., what we have done, it suggests that CBDC innovation will be more successful if it meets unmet user needs, achieves network effects, and is implemented using the existing accessible technology and infrastructure. So we have observed that the availability of the acceptance infrastructure is a key, and we are actually riding on the unified payment interface for this process also. And in order to improve acceptance, we are making it interoperable with the UPI, which will help us to achieve the universal acceptance. CBDC, in our view, should actually imbibe all physical features of the physical currency, including anonymity. And data privacy in today's area is a concern. And I think Eric mentioned about the cyber security and cyber resilience. I think these are very, very critical issues which we'll have to ensure so that the CBDC can be trusted as much as a physical currency. And one of the foundational considerations for the design of CBDC is that offline transactions also need to be facilitated, and I think we are working on how that can also be done. We also launched a wholesale digital rupee sometime in November 22, and it is used in the secondary market settlement of government securities. And this provides several benefits such as avoidance of the central counterparty charges and settlement guarantee infrastructure, or the need for collateral to mitigate settlement risk. In the second phase of the pilot, actually, we are also looking at interbank money market transactions, and future users could consider tokenization of securities and settlement based on smart contracts, and unification of the current siloed securities and monetary databases, which I think can give us significant gains, and tokenization would certainly offer this benefit. Then in order to modernize financial infrastructure will be required for this entire purpose. And central bank digital currency seems to be well placed to actually leverage the benefits of the technological innovations and tokenization while reinforcing trust in the monetary system. The coexistence of digital currencies can actually introduce risks that need to be carefully managed. Regulatory bodies and financial institutions should develop risk management strategies to address these issues. And I think the digital money actually offers opportunities to improve on design relative to today's system. They can develop, they can contribute to a well-developed infrastructure for digital transactions. And we have to ensure that the financial infrastructure can enhance the resilience, convenience, and also offer the cost efficiency and transparency. So that can actually help in promoting financial inclusion and growth. I will stop with that at this point.
Thank you, Regiswa. We've talked about the tokenization of central bank money, and I'll come back to the tokenization of private money later. But let's go to the asset side. Ravi earlier talked about asset tokenization. With different places, including in Hong Kong, we are piloting tokenized bond for the government, and people are piloting tokenized equities, tokenized funds, or even real-world assets, like Ravi said. I just wonder what our panelists think about asset tokenization. One, where is it going? Is it real? Is it really becoming a trend? Will it really form a substantial part of our future markets? And secondly, what impediments or what obstacles or what difficulties do you see for tokenization to go to the next stage of really getting into the mainstream? Are there difficulties that we are trying to tackle, or is really quite difficult to tackle? Maybe this time I'll start with Eric.
So I will be fairly short because I will listen to Ravi. He's, I think, the expert here in the panel. But maybe some principal thoughts here. So tokenization, I guess, tokenization, blockchain. You think about crypto. It's about decentralizing the financial system. It's even more or less, to some extent, a political movement, right? But for sure, there are merits, and I think Ravi underlined many of them. But the kind of settlement system is by definition today a centralized system. So you will take here a technology that should be or thought to decentralize the financial system and put it into a kind of a centralized, well, that's one thing. The other thing is that, of course, you need to have this coordinated globally, because if you're talking about securities, for example, that's a global traded asset, right? So some kind of coordination need to be done here. Having said that, I think we are in early stages. As I understand it, there's no really it's still in the test phase, so to say. Maybe a little bit more test, but it's not kind of a strong take-up at this stage. So I think central banks and regulators need to watch this, need to understand the kind of stability issues on it, and need to be prepared to act rather than to say that this is good or bad, because of course it's evolving technology. Thanks.
Ravi?
Yeah, thanks, Eddie. Coming back to tokenization of assets, and I want to link it to the earlier discussion on digital central bank money. I think one of the features we are looking for is atomic settlement. And that is so critical, because if you can achieve the direct exchange of two assets in real time, you have eliminated settlement risk, which is a big headache for many of us for decades. You don't have duplicative reconciliation processes, especially cross-border. And you don't have to set aside collateral and funds. Today we do for all cross-border transactions. So I think the elimination of settlement risk is one of the key benefits of using central bank digital currencies. Wholesale CBDCs achieve that. I think the payoffs in the domestic setting are not very large. We're also doing wholesale CBDCs for a live case next year, where we will settle the balances across the banks for their payments. I don't think the savings are huge, but at least it demonstrates the technology work. I think the cross-border setting, the savings are huge, because cross-border payments is easier. We already have that. India and Singapore have it. We can send money to each other because our instant payment systems are linked. But our banks have not settled yet. And that settlement risk is what adds mostly to the cost. So I think with wholesale CBDCs, you can do that. In Hong Kong here, you have mBridge, which is a multi-CBDC platform, which allows this to be settled on a platform because there's no central party in cross-border setting. And so you have a distributed ledger and multi-currency CBDCs doing that. In Singapore, we're doing the same thing with Dunbar. So I think we need to link the issue of atomic settlement with the use of CBDCs. It could be tokenized bank liabilities, but I think with CBDCs, there's a greater degree of trust, and most of the experiments are in that space. Then the tokenization of assets itself. I think experiments are being done in FX, in fixed income. You have tokenized bonds here in Hong Kong, and in equities. And I'll just mention a couple of them to say that they are beyond pilot. They are in production stage. The challenges are to scale. So FX, we are tokenizing foreign exchange to achieve a 24/7 global liquidity pool. The problem today is that you have very fragmented networks. So you want to free up this liquidity that is fragmented and trapped in different pools of liquidity by having a common ledger that keeps track of the movement of these tokenized FX. So this is something Bank of New York Mellon is doing together with OCBC Bank in Singapore. We are trialing the FX tokenization. And another example, tokenizing bonds. And especially, I think, for cross-border purposes. For domestic issuance, again, the cost savings are not large. But for cross-border issuance, end-to-end from issuance, distribution, and settlement of securities, there are live cases. UBS Bank is doing that with SBI Digital Asset Holdings, together with DBS Bank. And they actually did a pilot repo agreement with natively issued digital bonds, working across Switzerland, Japan, and Singapore. So there are very interesting pieces of work being done in many jurisdictions across. These are live transactions, not laboratory POCs that are doing this. The problem with scaling is that they are still in multiple networks. You don't have a unified ledger. The BIS has spoken about this. Augustine, when he was in Singapore, spoke about this. Should we think of a new financial architecture? If it's going to be tokenized, then can we have a layer of a unified ledger into which these assets can ride on? It's, I think, a very powerful concept, I think worth exploring. Will it work? I don't know. But like all good experiments and innovation, I think it's worth a try because the payoffs are huge. The International Monetary Fund is thinking about the same. And together with a group of about half a dozen banks, the MAS has announced a similar, we call it Global Layer 1 framework. And one of the things that this is supposed to achieve is that you can, through the use of smart contracts, build in regulatory and policy requirements onto the platform. So you have regulatory compliance by design. Today, most regulatory compliance is ex post. You build the system, you transact, and then you check for compliance. But through smart contracts, you can build in policy requirements, you can build in capital control requirements, you can build in AML and other regulatory requirements into the contract itself that governs this chain. So if you can build a global layer like that, that will be the ultimate global public good for the financial system of the future. Is it possible? I think technologically it is possible. I think it's a question of achieving harmony across jurisdictions in terms of the design elements and the governance structures for these things. And I think that's something that is worthwhile pursuing, and many of us are pursuing that.
Right. In fact, just to share that we've been piloting with our tokenized bond for the government. And one thing is, if you really want to scale that up, you need global standards, you need global platforms. What we're seeing now is almost like walled gardens with platforms that's operated by different firms, and they're not interoperable. And if you really want the tokenized asset world to take off, I thought one comment that we received is that can we have some kind of industry standard so that everybody complies with that, so that all these platforms become interoperable and it becomes one big marketplace. I think that's one thing that probably we might need to think more about. But you have mentioned cross-border payment, and with blockchain technology, the use of CBDCs, and we are seeing actually a lot of promise in solving the long-standing pain of cross-border payment being too slow, too expensive. And Rajeshwar, I know that India has been trying out different cross-border payment linkages with, for example, Singapore, and you are contemplating one with UAE probably. What are the issues that you see in pursuing all these cross-border payments, especially in terms of the differences in capital controls, AML, etc.? How do you resolve that? Is that a stumbling block that's really hard to overcome?
I think simplifying cross-border payments, as Ravi has also mentioned, in terms of costs, etc., I think there will be tremendous scope for using the CBDC. And it can actually simplify the intermediation and increase efficiencies, reduce the costs. Interoperability should be a core feature of this entire process. And, but practical implementation will require some amount of compromises between the countries concerned. And CBDC also provides us opportunity to start off in a clean slate, in the sense we can do away with the existing edifice, perhaps go ahead with a new structure which will be reflecting, which will harness the potential of CBDC in the cross-border payment space. And actually, we have started this process on a bilateral basis. In fact, with Singapore, we have the link with FastPay. You have QR code-based link usages in bordering neighboring countries like Bhutan, Nepal. We are also extending it to UAE. So at present, we have actually used more of a bilateral mechanism to process further. So it will be one-to-one country-wise, but maybe going forward in a multilateral basis, how do we do about it? I think that is something which requires a further amount of thought on this. Yeah.
Right. Well, in fact, on a multilateral basis, it's a lot more effective. I think that's what Project Nexus in Singapore, which concerns about linkages of different instant payment system, and mBridge in Hong Kong, which concerns about creating a CBDC platform for multiple jurisdictions. These are two really promising projects that might actually eventually get us a multilateral linkage instead of just bilateral linkages. But the interoperability issues probably is something that we still have to resolve. Ravi?
Yeah, Eddie, you're absolutely right. I think, and I think we need to unpack the problem statements. So there's one problem statement is about cross-border payments. The other one is cross-border settlement. And the linkages that we spoke about, the one that we recently did between Singapore and India, is where we linked up the two instant payment systems. We did that with Thailand, and we've done that in Malaysia. It's not rocket science, but still takes about 1 year of hard work because there are protocols, and India has certain regulatory requirements on capital outflows that have to be taken into account in this. But once you set it up, it's very easy. It reduces transaction cost to about 2% of transaction value. Today, I think many people for retail payments across borders pay about 6 to 8 to 10%, which is a crime. because these are poor people, migrant workers, you know, small and medium enterprises making small payments, and they get to pay this. So what we've achieved in small bilateral linkages is already a huge thing. You don't need CBDCs, you don't need blockchain, you just link two instant payment systems, and it's very fast. I did this with Governor Shaktikanta Das live, and the two prime ministers were watching us. Quite stressful, but with 3 clicks, I managed to send Das 100 rupees, and he returned the money, of course, in Singapore dollars. So even the FX is taken care of instantaneously. The settlement problem is the bigger one that we are trying to solve. And so mBridge, what Hong Kong is doing, and Dunbar, is about also having the 2 banks settle. Yeah. So today, I can send Rajeshwar money directly into his bank account by just knowing his identifier. Or mobile, using my mobile, and it goes directly as rupees into his account. But my bank has not paid his bank yet. So his bank is out of pocket, is facing settlement risk. But if he had e-rupee and e-Singapore dollar, wholesale CBDCs, then the 2 banks can exchange that, and they're settled. That is the difficult part, because we've not been able to scale that. So if we can push what mBridge and Dunbar and the Swiss are doing, with these experiments that are being coordinated by the Bank for International Settlements, I think we have a long way to go. For instant payments, I should mention Nexus, because the BIS Innovation Hub is fronting that rather than it's like signing free trade agreements. Bilateral FTAs are painstaking, so you have multilateral trade agreements, which everyone jumps onto, plugs into. And so the BIS is leading this project, Nexus, which tries to achieve multilateral platform for linking instant payment systems. And we're happy that 5 ASEAN countries, Malaysia, Indonesia, Thailand, Philippines, and Singapore have signed up for it. We're committed to have this, not only for ourselves, but eventually with a view to linking up with the Eurosystem, with Brazil, with India, with China, and others. And I think this will be a much lower hanging fruit, which will already confer substantial benefits to people without even going into CBDCs and blockchains and the like.
Yeah, I think there are 2 tracks that are going. Project Nexus is about linking up instant payment system, very good for remittances, small amounts. But in the longer term, the other track, Dunbar, mBridge, will provide you with a complete solution in terms also of settlement. And I can say that this clicks, doing the clicks using the faster payment system to make payment to other places in front of a camera is stressful. We did it yesterday together with Setaput to mark the linkage between FPS and PromptPay. And we have to do the transaction. I was afraid that it didn't go through, so it was all right. Now, we have about 10 minutes, so let me open up for questions. And you can use the QR code to send in your question that I can read here, or you can just raise your hand. Yes, over there, Darryl.
Thank you, Eddie, and thank you to the panelists for the very insightful sharing. I'm actually coming from the Monetary Management Department of the HKMA, and I do have questions about the implications of adoption of digital central banking currency. In the sense that, if you think about, the currency issued by central banks, right now in our real world, the notes and currency, and also the reserves held by commercial bank at the central bank are actually 2 segregated, separate pools of money, and they don't really talk to each other. So if you imagine a situation where we have loads of demand for cash and coins, and then the central bank just issue them, it won't really, contaminate or affect your monetary operations and the monetary conditions. But if we actually tokenize the cash and coins and central bank currency, and it makes it potentially much more fungible, with the reserves money held by commercial bank with the central bank, would that really complicate, our monetary operations and the central bank's influence over the general monetary condition? That's my first question. And the second related question is that, would you recommend separate the 2 pools, that, if we're going to issue digital central bank currency, we should actually keep it separated, from the reserve held by commercial banks with the central bank? That's my questions. Thank you very much.
Who would like to go first? Maybe Eric, you would like to try that? No? Ravi?
I think underlying that question is a deeper question of how much CBDC should a central bank issue. Today, notes and coins are issued just to meet demand. And because the demand is fairly low, the issuance of notes and coins, printing money in that old sense, doesn't create an inflationary or monetary problem because the bulk of your money supply is not in that form. Will CBDCs change that? Well, the answer to that is how much CBDCs will you issue? My personal view is that central banks should set a limit on how much CBDCs they issue. Because if a CBDC is akin to notes and coins and central bank reserves, then that is a small part of money supply, the monetary base, which is about typically 5 to 10%. And you don't want to issue more than that because then you're expanding the monetary base. And I also don't think you will have phenomenal demand for CBDCs. Both Eric and Rajeshwar said that. People like to have the optionality of holding a central bank liability in digital form, but why would you hold large amounts of that? It's non-interest bearing. So even in India, the take-up in the wallets is not phenomenal because there's an amount of money you'll keep for notes and coins and so for CBDC. So I think the demand will not be overwhelming, and as long as the central banks are prudent in the supply, I don't think it should complicate monetary operations as such.
I guess you could say that there might be a lot of demand in a crisis situation. That's the bank run equivalent. So therefore, we have been thinking of, and that's true also for other projects, I think, to have limits, as you say, Ravi. Otherwise, you might have unlimited bank runs, and of course, that would have large effects on stability.
And also now, I think there is a broader consensus that CBDCs should not be remunerated. If you remunerate CBDC, that will attract actually funds to go into it. Any other questions from the floor? Yes? Bob?
Ravi Menon emphasized the need for stable coins to be backed and regulated and sort of proper money. But the empirically largest stable coin to date was described in a cover story by Business Week in November 2021 in essentially hilarious terms and repeated in the book Number Go Up by the same author. So how do we account for the fact that the market, such as it is, has been so tolerant of, shall we say, such slipshod money?
Maybe Ravi?
It beats me too. I'm amazed at how, at the interest and demand that people still have for these highly volatile cryptocurrencies and so-called stable coins. It's despite the best efforts of regulators around the world, and now more and more of us are putting in place restrictions. And so in Singapore, we've placed a variety of restrictions on retail access to cryptocurrencies and so-called stable coins. The only distinction we make is with MAS-regulated stable coins, where we have assurance that it's fully backed and it's ring-fenced and it's on-prem, it's not going anywhere. Then it's, old-fashioned narrow banking. I think that works. I think when the controls around the backing for a stable coin are weak, then a lot of people are going to get deceived into thinking that they are going to hold value. And today we see many examples of that. Even those that are fully backed, I've noticed they have small volatilities, which reflects actually some degree of skepticism in the markets that the stable coin value will hold. So I would be quite cautious, but we do think that if well-regulated, they have a great purpose. And so we are gingerly embarking on that by putting in place a regulatory framework, licensing a few selected ones, and seeing what kind of applications they make on the innovation front.
And I should add that this regulation has to be done on a global basis because stablecoins can go everywhere. It's cross borders. So I'm really glad that the Financial Stability Board has come up with basic principles on designing the stablecoin framework so that in Singapore, in Hong Kong, in Sweden, in other places, our stablecoin legislative framework will be very similar, fully back, segregate client account, etc. And I think that's essential in order that we can have this additional layer of means of payment, which is well-regulated stablecoin. So in future, the way that I look at it is very similar to Ravi. In the CBDC will be the foundation layer where it will support the next layer, which is private bank money, comprising tokenized deposits and stablecoins, which will support the transactions of tokenized assets. I think that's probably the way that our future monetary system will go. All right. Any other comments anyone has? If not, I think we are right on the dot. I won't conclude or draw any summary, but I will invite you to join me in a big round of applause for our speakers.
Thank you very much, Eddie, and to all our speakers. Can I invite you all to come to the front of the stage for a group photo, please? We're actually going to have 2 rounds of photos, one with our official photographer, and then one for the media, because you're a photogenic group of central bankers. Everybody say swish. All right, stay there for our media friends, our media photographers who are at the back. Thank you very much again. Another round of applause for our panel, please. It now gives me great pleasure to introduce Mr. Pan Gongsheng, Governor of the People's Bank of China, who is going to give a keynote speech followed by Q&A. And this session will be moderated by Mr. Norman Chan, Senior Advisor, Hong Kong Academy of Finance, and former Chief Executive of the Hong Kong Monetary Authority. So please give a big welcome to Mr. Pan and Mr. Chan.
Hello, everybody. I must say I'm very, very pleased to see so many old and new friends. I think in my former life as Chief Executive at HKMA, if you call it a life at all, there's nothing comparable with so many serving governors and former governors in this big room. The closest is the IMF meetings. But there are 2 big differences. I see a lot of smiling faces here, but I don't see that at all. Ravi can testify to that. They're very serious and very solemn. And the second difference, even more important, they don't feed us. They don't feed us with good food, where we do try our best to serve you. So thank you very much, Eddie, Augustine, for organizing this very great conference to celebrate HKMA's birthday, 30th, and Asian Office BIS for 25th. Now, we are very honored to have Dr. Pan Gongsheng, Governor of People's Bank of China, here to give a keynote speech. Governor Pan should be well known to all of you, needs no introduction. After a very distinguished career in the Industrial and Commercial Bank of China and the Agricultural Bank of China, Dr. Pan joined the People's Bank in 2012 as Deputy Governor, and later took charge of the State Administration of Foreign Exchange. So clearly, Governor Pan has played a key role in the reform and development of China's banking and financial systems. But not only that, Governor Pan has been a good friend and supporter of Hong Kong. I had the privilege of working closely with Governor Pan over these years in helping to promote Hong Kong's position as the premier international financial center. I still have very vivid and fond memory of us too. In 2017 in Hong Kong, launching the Spawn Connect scheme, where we try very hard to beat the gong, the Chinese gong, bang, bang. And supposed to do it one time, so we're so happy. We did it 3 times, about what is permissible. So, without further ado, let us give a round of applause to welcome Governor Pan for his keynote speech.
Thank you, Norman, for your kind introduction. General Manager Augustine Cousins, Chief Executive Eddie Ru, ladies and gentlemen, good afternoon. It gives me great pleasure to attend the HKMA-BIS HighLevel Conference and celebrate HKMA 30th anniversary and the BIS Asian Office's 25th anniversary with you. I would like to take this opportunity to talk about how we see the Chinese economy, our monetary policy response, where we are in the financial sector opening, PBOC's participation in the international financial governance, and last but not least, the special role of Hong Kong in the international financial center. First, how we see the Chinese economy. China's economy has, as a whole, continued to gain momentum in recovery. GDP grew by 5.2% in the first 3 quarters, and expected to achieve the 5 growth target for the whole year. The IMF recently raised its 2023 growth forecast for China to 5.4%, which is still relatively high among the world's major economies. We could break down the GDP and take a closer look. For consumption, its contribution to GDP has been on the rise, and the service sector is doing well. In October, retail sales enjoyed a good growth of 7.6% year-on-year. For investment, in the first 10 months, manufacturing investment increased by 6.2% from a year ago. And if real estate investment were excluded, private investment would actually be growing by 9.1% year-on-year. Investment in high-tech has been growing fast at the rate of 11%. As for foreign trade, the value of imports and exports denominated in RMB stopped the decline and went up about 1% year-on-year in October. Quantity-wise, the volume of the import and the export has actually maintained a growth at around 10%. Over the past year or so, many central bankers around the world have been troubled by the problem of persistent high inflation. But for China, the problem is somewhat different. Now CPI is gradually bottoming out in China, it returned to positive growth in August and September, but dropped a little bit in October, mainly due to the 4% drop in food prices, especially a 30% fall in pork price, which is a very big component of the CPI in China. We don't think the fall in food price will sustain and expect CPI to go up afterwards. There have been some green shoots on the PMI front. Manufacturing PMI has in January stayed in an upward trajectory from May this year. Service PMI is doing much better and has stayed in an expansionary territory since the beginning of this year. When we look at China's economy, we need to pay attention to two things. First, China's GDP is already more than 120 trillion yuan, or 18 trillion US dollars. It would be difficult to grow at the rate of 8 or 10% like in the past. Second, China is experiencing a transition of economic growth model. The traditional model of relying heavily on infrastructure and the real estate might generate higher growth, but would also delay structural adjustment and undermine growth sustainability. High quality and sustainable growth is far more important. So right now, we should focus more on improving economic structure and forming new growth drivers. The ongoing economic transformation will be a long and difficult journey, but it is a journey we must take. Looking ahead, the Chinese economy remains highly resilient thanks to its strengths, such as innovation ability, big market, good infrastructure, well-established industrial chains, rich and well-educated human resources, just to name a few. As renewable energy and other new drivers of economy continue to grow, and as the recent policy measures gradually take effect, such as those supporting the real estate sector, reducing the debt burden of the local governments, as well as the issuance of an additional 1 trillion RMB central government bond. I'm confident that China will enjoy healthy and sustainable growth in the 2024 and beyond. Second, let me talk about PBOC's monetary policy response. In general, we have kept our monetary policy accommodative to support economic development. This year, the PBOC has used a mix of tools, including cutting the reserve requirement ratio twice, cutting policy rate twice, and guiding the market rate, including the LPR, to go down. As a result, monetary and financial conditions have remained favorable for economic development. M2 and the total social financing increased by 10.3% and 9.3% year-on-year in October, respectively. The weighted average lending rate of corporate loans was 3.8% in September, the lowest level in the recorded history of the PBOC. In the meantime, we are also making use of structural monetary policy instruments when appropriate in support of small business, green finance, and innovation. As of the end of third quarter this year, PBOC outstanding lending through structural instruments totaled 7 trillion yuan, about 15% of our balance sheet. Going forward, the PBOC will continue to keep its monetary policy accommodative to provide support to our economy. Third, let me talk about where we are in the financial sector opening. First, we have significantly expanded market access for foreign financial institutions. We have removed foreign ownership cap for banks, insurers, and securities companies, and substantially expanded their business scope. We have also improved institutional arrangements underlying financial opening, including regulatory rules, supervisory standards. Many foreign financial institutions have established a commercial presence in China. About 2 weeks ago, we just issued the bank card clearing license for MasterCard to operate in China. Over the last 2 months, Vice Premier He Lifeng held roundtable meetings with the business communities in both Germany and the United States on the sidelines of his visit to those 2 countries. The PBOC also has a fine tradition to regularly listen to the financial institutions to seek their advice and suggestions. I sat down with the representatives of foreign financial institutions in Beijing this September. And this morning, I have just met with the representatives of the financial institutions here in Hong Kong to say where we could help to make their business easier. Second, we have a broadened opening of China's financial markets. China now has the world's second largest bond market. China's stocks and bonds have been included into the leading global indexes, such as MSCI, FTSE Russell, Bloomberg Barclays, and JP Morgan. Foreign investors now hold around 3.3 trillion yuan in China's bond market, growing at the annual rate about 30% in the past several years. Responding to the demand and the desire of the international investors, we have made it more convenient for foreigners to invest directly in China's financial markets. Meanwhile, through our source of connected schemes, such as the Stock Connect, the Bond Connect, the Swap Connect, we are providing foreign investors more options to invest in China through other channels, of which Hong Kong plays a prominent role. Hong Kong serves as a key bridge connecting mainland's financial markets with the international market. Third, RMB is more widely accepted and used in international trade and financial transactions. The PBOC follows a market-driven approach to cross-border use of RMB and focused on improving institutional arrangements and financial infrastructure. The international use of RMB has been rising steadily in the cross-border payments, investment and financing, and foreign exchange reserves. The international use of RMB has started to generate network effect and is providing more choices for market players at home and abroad. It has facilitated trade and investment, reduced exchange rate risks, and cut currency conversion costs. China's experiences have shown that opening up is a strong driving force for high development of the financial markets. It helps the financial sector to better support the real economy and become more competitive internationally. Fourth, let me briefly talk about PBOC's participation in the global financial governance. The world has entered a period of turmoil and transformation. And the international governance system is also undergoing profound changes. The PBOC has long been an active participant in global financial governance through such fora like the G20, the IMF, and the BIS. We are also actively participating in bilateral financial cooperation. This year, China has established financial working groups with both the US and the EU. The PBOC is the leading agency on the Chinese side for both groups. They provide ongoing channels to strengthen communication, coordination, and macroeconomic and monetary policies, promote financial stability, and deepen practical financial cooperation with both the US and the EU. Going forward, the PBOC will continue to uphold multilateralism and contribute our share to more, not less, economic and financial integration of the world. First, we will strengthen macroeconomic policy dialogue and coordination to jointly promote global growth and financial stability. Second, we will push for global governance reform to make financial governance more fair and more efficient. This will include improving IMF's governance structure and representativeness. Third, we will work with other economies to keep global industrial and supply chains stable and promote economic globalization that is more open, inclusive, balanced, and beneficial for all. Last but not least, let me talk about the special role that Hong Kong can play as an international financial center. Hong Kong is one of the major international hubs in the world. It has an open and free business environment, sophisticated financial markets, well-functioning financial infrastructure, a vast talent pool, a sound legal system, and a regulatory system well aligned with the international practices. It is the world's largest offshore RMB market. It is also Asia's largest asset and wealth management center, and the second largest center for hedge funds and private equity. The PBOC is committed to supporting Hong Kong's role as an international financial center. We will continue to create an enabling environment for the RMB business in Hong Kong. We will continue to support Hong Kong's role as an international asset center and the risk management center, and its goal to become a fintech and green finance hub in the Asia-Pacific region. We will continue to support Hong Kong's financial stability. We believe that with all these strengths, a favorable policy environment, and its talented and hardworking people, Hong Kong, standing as an international financial center, will be further enhanced. That is my today's speech. Before I take up your questions, let me wish this conference a great success. Thank you.
Thank you. Thank you, Governor Pan, for this very comprehensive speech covering different aspects of China's economic and financial developments. Now it's Q&A time, all right? I received quite a number of inquiries from participants who asked me to raise this question with you. As we know, the property sector, the property market in mainland China has got into trouble for a while now. It's an area as concerned that lots of us, bankers or central bankers alike, are quite concerned about. It's something you can share with us. What's your
current assessment of the situation? And also, there are some measures that have taken by the authorities to address the problem. And what do you think the situation will become? Would it be enough to stabilize the situation going forward? Would you be kind enough to share with us your insights?
There is a fluctuation in the property market, not only in China, but in many countries. Thank you for your question. Yeah. I understand that there are a lot of the concerns about China's property market. Let me share some of my observations on this issue. China began its housing reform in the 1990s, 3 decades ago, with the acceleration of urbanization. Please take it.
He's very kind. Respect for the old man.
With the acceleration of urbanization and industrialization, China enjoyed a real estate boom for almost 3 decades. So people's living conditions in China have improved significantly. And the per capita living space for urban residents is more than 40 square meters. I don't know how much in Hong Kong.
Small.
After decades of rapid expansion, the real estate sector in China is in the middle of the major transition and has the following characteristics. The first, demand for newly built housing is on the decline. Second, the real estate market varies from city to city. Housing demand in the first or second tier cities is expected to remain solid. But in some third or fourth tier cities, it's on the decline. Third, as the urbanization continues, demand is shifting from the new houses to pre-owned ones. Rental demand is also on the rise. So as a result, the real estate market is experiencing some adjustments. In the long run, such adjustment is beneficial for the transition of China's economic development and growth sustainability. But in the short run, we should focus on mitigating the spillover risks and smooth the transition process. To this end, we have taken a host of measures, including cutting down payment ratios, reducing mortgage rates, encouraging commercial banks to renegotiate old contracts with borrowers to cut mortgage rates. That is, years ago, the individuals borrow the borrowers that is the interest rate is high. So we encourage the commercial banks to renegotiate with the borrowers to cut the mortgage rates. Relaxing purchase restrictions, providing financial support for the timely completion and the pre-sold housing, providing no-cost financing to local governments for them to purchase homes from developers and offer them as a public rental housing to the low-income people. Supporting reasonable financing needs of developers, encouraging financial institutions to support debt restructuring of developers, and support the restructuring, mergers, and acquisitions in the real estate sector. As these measures gradually take effect, we have already seen some positive signs. In the first 3 quarters, floor space sold has increased by 6.8%, of which secondary housing market has increased a lot. The decline in the sales of the new houses has also narrowed significantly compared to the last year. It's narrowed significantly. When we look at the spillover of real estate as a central bank, we are concerned about we pay attention at the spillover effects of real estate sector and the financial system. It is quite limited. Let me give some numbers. Of the standing real estate loans, about 53 trillion RMB, accounting for 23% of the total bank loans. Around 8% of them are mortgage loans. China has all along followed a highly prudential mortgage lending policy. And now the NPL ratio for the mortgage is 0.52%. That the NPL for mortgage loans is 0.52%. Loans to developers account for about 20% of real estate lending. Their NPL now is at 2.7%. In general, China's real estate sector is searching for a new equilibrium. Yesterday, I read a report by Standard & Poor's. According to this report, market sentiment, contract volume, and prices in China real estate sector have begun to show signs of normalization. It estimates that the property market has nearly reached the bottom. That is the views of the Standard & Poor's. Looking ahead, as the urbanization is still ongoing, the group of the new urban residents is large and growing. The demand for basic and improved housing is still large. We believe the foundation for the health and stable development of the real estate sector remains solid. Thank you.
Thank you, Governor Pan. Noting it's almost 12:30, I think we still have time for one question from the floor. Tim Lewis, Chairman of the Hong Kong Securities and Futures Commission. Tim, go ahead.
Thank you, Norman. Governor Pan, there have been concerns in the market relating to the increase in local government debt in China in recent years. So my question is, what is your assessment of the overall situation and the potential risks associated with local government debt? Furthermore, what measures have been implemented by the various authorities to mitigate such risks, and how effective have such measures been so far? Thank you very much.
Thank you. Thank you for your question. There is a lot of the discussions about China's local government debt. Let me share with you my take on this issue. China total government debt. Let me first speak about the China's total government debt level. It's in the middle and lower range by international comparison. By official definition, as of the end of the last year, the government debt totaled 60 trillion RMB, accounting for about 50% of our GDP. In this total, central government debt accounting for 21% of GDP, it is relatively low. Local government debt was around 35 trillion RMB. Using the BIS deflation and the data, which include of the balance sheet debt, China's government debt is about 78% of GDP. It is still relatively low compared to the 109% for advanced economies and the 94% for the G20 economies. Through slightly higher than the 65% average for emerging market economies. Chinese local government debt has two features. The first, the debt was borrowed for infrastructure investment. It is backed by the tangible assets, has generated positive externalities on the local economy over the past 3 decades. Two, China is a large country with great regional disparity. Most of the local government debt is issued by the government in the eastern and central provinces. With both the economic fundamentals, for them, the debt is not a big problem. It is just a handful underdeveloped provinces in the west and the northeast China that may face some difficulties in debt servicing. We have taken the following measures to address the debt problem. Placing more strict fiscal disciplines on local governments, such as restrictions on new borrowings for investment in provinces with debt problems. Tightening accountability to ensure local governments take their own responsibilities. They are encouraged to sell assets to pay debts. Encourage financial institutions to negotiate with the local governments in debt restructuring based on the market and commercial principles. Encouraging local government financing vehicles to transform into market-based entities through M&A, restructuring, or capital injection. I believe as these measures gradually take effect, hopefully the debt issue in some underdeveloped regions were mitigated, and this issue will gradually get resolved. Thank you.
Thank you very much. I must bring this session to an end so that you can have some lunch. A lot of hungry faces I can see. Now, may I invite you once again, give a round of applause to Governor Pan.
Thank you very much, Mr. Chan and Mr. Pan. And could you please stay on the stage for a second for a photo? 2 rounds of photos, one for our official photographer and one for our friends in the media. Okay, and our media photographers are at the back of the room. A big smile for them. Wonderful. Thank you again, gentlemen. As Mr. Chan just mentioned, you do look hungry, and lunch is coming. Lunch will be served in the room here, so you don't need to go anywhere. And we will be back at 1:30 with our next panel. Enjoy your lunch. Bon appetit. Ladies and gentlemen, welcome back. Welcome back. I hope you've had a wonderful lunch, and if you're worried about the post-lunch slump, don't. Our next panel will make sure that's not going to happen. Over the past 30 years, the world economy has experienced multiple shocks. The Asian financial crisis of 1997-98, the global financial crisis of 2008-09, and of course the global pandemic just a few years ago and its aftermath. Central banks, alongside other authorities, have adapted and adjusted their policy tools to cope with these challenges, including reviewing and updating their mandates. But we're in an increasingly uncertain world where inflation is likely to stay higher for longer. Technologies are shaping the financial and economic landscape in very fundamental ways, and international cooperation is increasingly under pressure. How can we draw wisdom from the past to better prepare for the future? These are big questions, and we expect our panel will have some big answers. So please welcome our moderator, Mr. Joseph Yam, non-official member, Executive Council and former Chief Executive, Hong Kong Monetary Authority, and all our panelists. They are Dr. Zeti Aziz, Founding Chair, Asia School of Business, and former Governor, Bank Negara, Malaysia. Jacob Frenkel, Chairman Emeritus, Group of 30, and former Governor, Bank of Israel. Philip Hildebrand, Vice Chairman, BlackRock, and former Chairman, Governing Board of Swiss National Bank. Philip Lowe, former Governor, Reserve Bank of Australia. And Masaaki Shirakawa, Distinguished Guest Professor, Aoyama Gaoken University, and former Governor, Bank of Japan. Please give them all a warm welcome.
Shall we start? First of all, actually, a happy birthday to the HKMA and to the BIS Asian office. Now, I'm a person who is in the position to say that because I started the HKMA, and I started, well, with the help of the BIS, started the BIS Asian office here 25 years ago. And in saying that, I have to thank one person up there, who is Andrew Crockett. He actually was the... I miss him. He actually was the midwife delivering the HKMA, and I lobbied him to set up an BIS Asian office here in Hong Kong. So thank you very much, Andrew. Miss you. And thank you very much, Augustine and Eddie, for inviting us. We are really a bunch of geriatric central bank governors. But we're determined to have a bit of fun, actually. Well, now, obviously, we are happy to share our long past experience in central banking to see if we can help our successors, some of whom we actually groomed over the years, and to see whether we can help meet the challenges, the many challenges they face. Now, since we are all retired, we have no responsibility, we can talk freely, and we don't need any steering. But we do need a bit of introduction. And I will start from the far left, Shirakawa-san, Bank of Japan, Governor Bank of Japan from 2008 to 2013. He had 4 decades in the Bank of Japan. He was also Vice Chairman of BIS Board for 3 years, and currently he is Distinguished Guest Professor at Aoyama Gaoken University in Tokyo. Next is Philip Lowe, who just finished his term as governor at the RBA, Reserve Bank of Australia, 2 months ago, after another 40 years service at the bank. He also served as the chair of the BIS Committee on Global Financial Stability, what we call the CGFS, between June 2018 and September 2023. And then another Philip. Hildebrand. Joined the governing board of the Swiss National Bank in 2003, became vice chairman in charge of financial stability in 2007, and then chairman from 2010 to 2012. During his time, Philip was also appointed vice chairman of the Financial Stability Board, expert in financial stability. Currently, Philip is vice chairman of BlackRock. Now, Jacob needs really no introduction for us veterans, but he was governor of Bank of Israel during 1991 to 2000. And during 87 to 91, he was the economic counselor and director of research of the IMF and served as chairman of the Group of 30, a very prestigious group during 2001 to 2022, over 20 years of chairmanship there. He held top positions in a number of private institutions, including Merrill Lynch and JP Morgan. Now, last but not least, Dr. Sethi, my dear friend. We were born in the same year. We both had 16 years as governor of a central banking institution. We lived through the two crises, the Asian financial crisis and what they call the global financial crisis. She's currently the founding chair of Asia School of Business in Malaysia. So that's the introduction. Let's get on to business. Now, I understand from Augustine that this morning the sentiment was that perhaps you have done a great job in lowering inflation and not causing too much concern in financial stability while maintaining a low unemployment rate. Very good score there, But circumstances are different from what we have experienced before. Now it's also complicated by geopolitics as well as the advancement of technology. Now, Jakob, I want to start with you. Now, he's the person, you better be careful, because he is famous for being able to give you an insightful soundbite that you will remember for the rest of your life. I can still remember one. No bank is too big to fail, and no bank is too small to be bothered with. That's from him. Jakob, what do you think about, the efforts of our successors in bringing down inflation? Have they done enough? In various jurisdictions, inflations are actually still pretty high, and interest rates are still negative. What do you think?
Thank you very much, and I'm really delighted to be here. I've never been introduced as the head of the geriatric department, so I will take you to the infancy. I was for many years a professor at the University of Chicago, and I stopped teaching because I did not want to be bothered with giving so many grades. And now at this stage of my life, you ask me to grade my colleagues and former colleagues. But I can tell you, in the past, central banking was much simpler. In the 30s, there was a classic book by Ralph Hawtrey, the title of which was The Art of Central Banking. And those of you who will go to look at it will not recognize what you are doing now with the title of central banking. Maybe because it is the art, and art is not science, and we occasionally think that we are scientific, so we need to be careful about it. But you asked me about has central banking changed dramatically, and about inflation and all the rest. The fact is that if you look at the age distribution of governors and of young people, now young entrepreneurs, until very recently, you will think that inflation is part of the dinosaurs era. And inflation is like smallpox, it's been evaporated. And that's why there is a danger in it, because if you never experienced inflation, maybe you don't take the guards against inflation. We are now in a phase in which inflation has burst, and it has surprised many of the central bankers all over the world, not of course you, because you knew it all in advance. But the fact is that central banking in the past was much simpler. You knew you have to achieve price stability, and occasionally, if you were in college at the wrong years, you thought that there might be a trade-off called Phillips curve, but by and large, it was relatively simple. And then suddenly, crises came one after the other. And when you look at all of these crises, you see that they all primarily have had the same origin, financial markets. And if it is financial markets, you will never hear the word financial markets in the Ralph Hawtrey book, or essentially in the first generation of central banking. And those of us who have been long enough there and coming to the BIS meetings will recall that it was the BIS actually that brought it to the fore with a lot of objections by the leading central bankers at the time. And so I think that it is worth recalling, and not only recalling, but also recognizing and acknowledging the extraordinary contribution that the BIS has made to bring us to where we are in the analytical framework. Having said this, and we have here people who are either have been or are in the FSB and all of those things that are now occupying central banking, we still have to ask ourselves, how come inflation surprised us? After all, in many of the crises that we have had more recently, not only the financial crisis, but also the real crisis, we have flooded the markets with a lot of liquidity for maybe good reasons, but we should not have been surprised with the outcome. After all, this money did not go to the moon. It went to some places. So where will it go? It went to the financial markets. Why did they go to the financial markets? Because interest rates were so low. And it exploded, and therefore suddenly it looked like you are having prosperity as measured by financial markets, and the disconnect between real and financial economies became apparent, and it was clear that since financial markets at the end of the day must mirror the real economy, the numerator and the denominator, those things will need to come together one time. And they came together. So we should not have been surprised. So why did we waste so much time in asking whether the burst of inflation is transitory or permanent before we actually dealt with it? And the reason is really conceptual. The conceptual one is, do you look at the rear view mirror when you drive, or do you look through the front? It doesn't matter whether you look through the rear view or the front window if the road is very straight. And if it's straight, you will never get into an accident, whatever way you look at the road. But if the road turns around, then looking at driving by the rear view, you know that you are going to be having an accident. And the question was, therefore, are the shocks permanent or transitory? I think it's the wrong way to pose the question. Because the role of a central banker is to ensure that those shocks that come to the system, that upset price stability or financial stability, become temporary because of the actions that the central bank will take. And since everyone will know that the central bank will be courageous enough and will have the legal independence to execute his belief, all shocks will become temporary. And if they become permanent, then it means that you failed. So rather than waiting to see if it was permanent or transitory, which is the recipe of falling behind the curve, by definition, the issue of forward-looking is important. And that's where the more recent crisis has led us, in a way, astray, because models failed. Models failed because they were built on the past record, like most models are. But if the roads turn around and the past is in fact, excess luggage rather than an advantage. That's where the analytical perspective needs to be developed and a concept. So central banking indeed has changed dramatically, and some of it is because the world has changed. Some of it is because we have had new shocks. We have never had to deal simultaneously with the financial shocks and then the real shock, then pandemic, then war. That has price implication, and we confuse them ourselves whether supply shocks need to be accommodated or fought. All of those things were in the background that make the life of central banking very different than the one that Ralph Hawtrey had in mind when he wrote The Art of Central Banking. But still, it means that economic analysis and foundations are the key rather than just time series analysis when you have unstable structure. Let me stop here.
Thank you very much, Jacob. Let me move on to Shiragawa-san, because he's experienced, or under his watch, inflation in Japan has been low, and now you are seeing an uptake of inflation. We don't know whether that is transitory or permanent, as Jacob pointed out. But we know that it is something that you wanted, actually. And we were wondering whether or not, the lack of action recently in actually dealing with the increase in inflation, which is now up to 3.5% or whatever level. What sort of considerations were behind this sort of delay in action?
Okay. First of all, when I was a governor, the discussion was always about low inflation or deflation. And Bank of Japan was often criticized by not being aggressive enough. And many industrial countries are citing Japanese experience of showing the period of deflation. Look at Japan. So we have to make every effort at avoiding Japanese style of deflation or low inflation. That was up until 3 years ago. Now many countries are coping with how to contain inflation, and situation has changed. And many reasons are cited. But one of the important causes for high inflation is, I would say, the failure of intellectual model, which many economists and policymakers were adopting. So in that spirit, I'd like to talk about Japanese low inflation or deflation experience. Yes, Japan recorded the low inflation or deflation. And at the same time, Japan recorded low growth, which was in sharp contrast to the remarkable success in 1980. So in that sense, it is natural for people to think that low inflation or deflation is very dangerous. But I'm very skeptical about this kind of argument. And we have to look at the fact without preconception. Between 2000 and 2012, which price level ceased to decline, the GDP growth rate among G7 countries, Japan's growth rate is the lowest among G7 countries. But if we look at growth rate of GDP per working age population, Japan is the highest among G7 countries, which is much higher than that of the United States. And during this period, working age population declined by as much as 15%. 15%. This is a huge headwind. And this loss of GDP cannot be solved by aggressive monetary easing as such. The fundamental issue is how to cope with declining population and how to boost productivity. That is real issue. But nonetheless, many people flirted with the idea of how to boost inflation. And unfortunately, for instance, some countries adopted average inflation targeting. Japanese experience was used as a justification for adopting average inflation targeting. And so one of the lessons which other countries should draw from Japanese experience is you should not be overly concerned about low inflation or deflation as such unless financial system stability is maintained. And so in that sense, deflation in 1930s is quite different from very mild deflation in Japan. And that is one lesson. And today, Japan is seeing some increase in inflation. And by Japanese standard, this is very high inflation, although this is somewhat lower than that in other countries. And nowadays, economists tend to view the rise in inflation as a possible sign for change in Japanese revival of the economy. But I dislike this kind of argument. And as I said, low inflation or a slightly higher inflation is nothing to do with fundamental issues like population change, demographic change, or productivity increase. So what I'd like to emphasize is productivity, and productivity, not flat with the idea of deflation. And so that is my take on Japanese inflation and the possible implication for other countries.
Thank you, Shiragawa-san. When looking at the inflationary situation, I think that central banks are doing a good job in lowering them without affecting significantly financial stability. But I don't think that the job is done yet. And I also do not think that the high for long interest rate scenario has yet fed through to totally to financial markets, and there may be dislocations of one sort or another that we have not yet seen or experienced. At which point I would actually like to turn on to the financial stability issue. Dr. Sethi, you have handled the two crises, the Asian financial crisis and the global financial crisis, very successfully. And each time, Bank Negara and Malaysia come out stronger. You must have a secret. Now, I would like to ask you whether how you see the current situation. Is the next one around the corner? Is the next one coming? What advice do you have for our central banking colleagues as to how such a situation should be handled?
Well, first of all, let me first congratulate the Hong Kong Monetary Authority on the occasion of their 30th anniversary, and to the BIS Hong Kong office on their 25th anniversary. And I should say that it's perhaps fortuitous that I'm on this panel today and moderated by Joseph Yam, because almost 15 years ago, when Bank Negara Malaysia celebrated our 50th anniversary, and that was about 15 years ago, that was attended by 50 governors. And Joseph Yam was our first speaker to commence our celebrations. So I'm delighted to be here today on this panel. Now, probably the biggest lesson for us after we experienced the Asian financial crisis was we needed to build our resilience. And that is how we've survived from East Asia in particular, affected by so many developments since then, which is about 25 years ago. Time and again, we've survived, not to say unscathed, we were affected, but we didn't land into a crisis situation. And this was by building resilience. And we did it in several ways, but for us in the emerging economies in particular was diversifying our financial system. That was very important so that it's not bank-centric, where all the risks are concentrated on the banking system. We developed our capital markets, and what is important in developing our markets and talking about markets where many of the crises originate from, is correct. And you also need to develop the players. And when you develop the bond market, for example, you need the insurance sector, the pension funds, the asset managers, and so on, so that they are institutional investors in these markets. And so I read a report once, the BIS report, before your time, Augustus, that it said that 40% of the bondholders in our market in Malaysia was held, the papers were held by non-residents. And with the taper tantrum, there'll be an exodus from the market, and there will cause the risk of a collapse of the market. But that didn't prove to be correct, because when there was a sell-off, indeed, when there were massive outflows and there was a sell-off, the domestic institutional investors stepped in. So the yields actually didn't move as much as what was predicted. And so this is important in part of building the resilience. But let me come to the more recent development relating to interest rates. Now, in relation to this, I wish to highlight two things. That there's already an international consensus regarding the management of the 2008-09 crisis. And I should mention, and I did mention to Joseph, that we shouldn't call it a global financial crisis, the GFC, because Asia Pacific and many parts of Latin America didn't experience, we were affected, but we didn't experience a crisis. And therefore, well, if you want to keep the acronym of GFC, it can be the Great Financial Crisis.
We did have to do something to defend ourselves, though, in 2008.
Yes, we did, but we were relatively more resilient. And I'm not saying that we weren't affected, we were affected, but we didn't, our financial intermediation continued to function, and we progressed and recovered from it quite quickly. And we had growth recovery, unlike the low interest rate. But during that period, after that period, there's already a general international consensus that there was an over-reliance on monetary policy and that interest rates were too low for too long. And also, for the current inflationary conditions, and this is something that Jacob raised already, that there was also a delay in the policy response to normalize and to tighten interest rates. And this has prompted, because of the delay, it has prompted the need for a more pronounced adjustment in the interest rates. Now, during the 2008-09 crisis, the emerging market economies did not bring interest rates to those all-time lows. And in the current period of inflationary conditions, many emerging economies had started to raise interest rates much earlier. And when I talked to those from Latin America, they said, well, before it was recognized, they had already started to raise rates. So for these two reasons, emerging market economies should not be expected to shadow the interest rate movements of the advanced economies. And there should be a decoupling of the extent of interest rate movements in the advanced economies and the emerging economies. That's very important because, and then moreover, many emerging economies have had a track record of successfully managing bouts of inflationary conditions in their economy. So given this, there should be a recognition of these differences, which would then should not produce an overreaction in the markets to produce an over-adjustment in the exchange rates, foreign exchange markets, and also and also on the impact on potential growth and development in the emerging world. Thank you.
Thank you very much. You didn't answer my question. One of my questions is the next one around the corner?
Well, I would say that we need to anticipate that it will be around the corner and be in a state of readiness. And if it is around the corner, and if we are in a state of readiness, it will be short-lived.
Thank you very much, Dr. Sethi. Philip Hildebrand, I would like to ask you the same question, actually, given that you've been, well, instrumental in introducing quite a lot of post-crisis reform to the financial system, being vice chair of the Financial Stability Board. Yet, you are now also in the private sector in BlackRock. You obviously would look at market developments. And like me, I'm sure you noticed some dislocation in the debt market, the US Treasury market, for example. And those are signs that to us here in this part of the world are actually quite worrying. Now, what do you think? Is the next one around the corner? Or have we done enough to stop history from repeating itself?
Thank you, Joseph, and thank you for having me. Eddie, it's wonderful to be here. I remember coming to Hong Kong when the BIS office, I think, had about 5 people, maybe, at the beginning of my tenure at the SNB, so it's wonderful to see what's happened here. It's also testimony to the long-term thinking of central banking that we haven't aged at all of us up here. So. Look, I think what is around the corner, Joseph, is that the world has really changed quite fundamentally, and we should, as we think about banking, crises, financial markets, we need to put that in the context of how the global economy has changed. And I think the key change is not so much that we had this spike of high inflation that we're going to get back under control, but it's really the supply side of the global economy. We are facing significant constraints on the production potential of the global economy that will likely be around for a persistent period of time. This means the inflation dynamic, irrespective of whether we reach the 2% or not, are going to be quite different. You know, during the Great Moderation, I think nobody saw this more clearly than Mario Draghi in a way. He realized that the production potential of the global economy kept expanding for various structural reasons linked to globalization, to China, and many other things. And as a result, he understood that no matter how much demand you had, you really wouldn't get inflation. And I think that's the kind of underlying macro story in a sense of the Great Moderation. As we have now shifted to a very different world where we have constraints around fragmentation, geopolitics, the transition to net zero, trade that is being constrained, aging, of course, as a very important structural factor. We are facing, I believe, significant supply-side constraints. This means that we're going to constantly kind of bump up against sticky inflation, even when we get to 2%. And I have no doubt that we will reach these targets again. but the underlying dynamic is going to be quite different. For decades, we basically had a structural bias towards easy policy. Now, I believe we're in for a long period, perhaps a very long period, of a kind of structural bias towards tightening policy. This changes the way financial markets behave, this changes the way banks behave, and you can see this quite clearly in the contraction of bank deposits that we're seeing in the context of the change in monetary policy and the very aggressive change in interest rates. So a lot of money is shifting away from banks into capital markets. Now, in many ways, this is good for savers, it's good for capital markets, it's good for BlackRock. But I think it does mean we have a different dynamic around banking. Banking is going to get more expensive. Banks have to compete for deposits when you get paid 5% interest on cash rates. We've seen this. So they need to raise interest rates. My successor, Thomas Jordan, has just given an interview over the weekend complaining rightly that the banks have not really adjusted the rates they pay on deposits in order to try to protect their profitability. So I think these changes in the structure of the capital markets, away from banking towards capital markets, mean that crises are going to be quite different. One space, if I were still in charge at the FSB, that I would watch is the entire kind of what's going to happen in terms of private credit lending from the capital markets. This is a whole new infrastructure. If you look at what's happening in many of the private market firms, they're connecting with insurance companies in order to have access to big balance sheets, in order to be able to lend to the private sector. In many ways, this can bring innovation, new forms of lending, but it also means the reaction when things go bad is going to be quite different. A bank knows its clients. It can deal with the clients. It has a history of the client's behavior. If you're lending out of capital markets, that's going to be a very different ballgame when things get tight. So I think this intermediation away from banking into capital markets is the space that I will watch most closely. The good news is, you know, banks have done pretty well given the size of the shock. We've just seen the most aggressive interest rate hike in history, at least since the 70s. And, you know, by and large, the banking system has been pretty robust. The cases where we've had crises were really management mistakes, business model mistakes, as opposed to anything systemic. That's the good news. I think where we have to watch what happens here as the system intermediates away from banking into capital markets, and this, of course, in a way is much harder to observe, it's harder to regulate. The entire BIS system, the entire regulatory system is still very focused on a banking-based model. And I think the question will be what happens in a world where inflation is sticky, we're in for a kind of long-term structural bias towards tightening, and we've seen shifting away from banking into capital markets. How does the system behave in that kind of world when the inevitable stress points come, as was just mentioned?
Are stress points actually appearing in these capital markets at this point of time? I mentioned the dislocation in the treasury market. The participants are not really banks as such, and they're not really regulated. You know, where are the risks? Are risks lurking around that we are not aware of? Is the Financial Stability Board, sorry to say this, doing an adequate job? You know, I mean, I'm born to be worried. I am worried, actually. What do you think from the perspective of, an institution, BlackRock, that is very much involved in many of these things?
I would say, again, I would watch two areas. One is what happens when private markets adjust their valuations to public markets in the aftermath of the interest rate, the very significant changes in interest rates. That process is not complete yet. Obviously, it also depends where public markets settle in this new environment. But I would say that is one space to watch. You know, what happens as holders of private market exposure inevitably have to begin to readjust or adjust their valuations. How do they react to that? Do they sell liquid equities in order to make up for that? Do they try to compensate elsewhere? And I think that's a process that's only just begun. The second one is the one I mentioned. You know, what happens to credit behavior as more and more credit provisioning happens in the capital markets and no longer just in the banking system? Can we, as this happens, can we fuel the economy sufficiently out of the capital markets? Now, many, particularly our US colleagues, will say that's a very good thing when that happens. It remains to be seen. In Europe, for instance, as you know, most corporates are still funded very much through the banking system. So how do we keep up a sufficient flow of credit when these changes occur away from the banking system into the capital markets? So I think there are places that we should look at very carefully. But again, on the whole, I'm encouraged by the way the system has, in a sense, been resilient, at least so far, in light of this very extreme change in interest rates that we've seen. I think if all of us had been asked a year ago what happens when rates go from 0 to 5%, we probably would have said a lot more than what we've actually observed so far.
Yes, yes, I think I agree with you. But I tend to worry too much anyway. So let me turn to Phil. Looking at Australia from Hong Kong, I think the RBA has been very successful in, at the same time, curbing inflation and maintaining financial stability. Although inflation now is still negative, I mean, real interest rates are still negative anyway. You seem to have struck a right balance between, you know, ensuring price stability and financial stability. Now, on the other hand, at the same time, I've just learned from the news that, you know, the Australian government is changing the mandate of the RBA. I mean, such a successful institution, and why are you put into such a situation? Although you have just retired, that's why I asked you, because you'll be freer to talk about these things.
Well, there's no kind of fundamental shift in the mandate here. The mandate of the RBA has always been price stability, full employment, and the general welfare of the Australian people. And under the legislative changes that the government's proposing, that's still going to be the case, although there'll be some kind of rewording. But fundamentally, the central bank will still have a dual mandate, which is appropriate. Perhaps I can just return to some of the other issues that we've discussed. I think the coming years are going to be much more difficult than the previous years, and I think we're going to see a lot more variability in inflation than we've had for the last 30 years. Over the past 30 years, we all got used to the idea that central banks could control inflation within a very narrow range. I remember being in trouble in the press and with the politicians for missing the inflation target by 0.5%. I always felt like it lacked perspective. I think going forward, we're going to see a lot more variation in inflation. Philip touched on some of the reasons. More supply shocks, climate change, the adjustments in our energy system, geopolitics, and demographics. All those things mean that we're going to be hitting the steep part of the supply curve more often, or the supply curves are going to be moving around, and inflation's going to be more volatile. And we're going to have to get used to that. And this is why I think the current inflation test is so important, and it's so important we pass it. This is the first example of this more volatile inflation world. Many countries' inflation went to 10% or close to it. 5 years ago, people would have thought that was completely crazy, but it happened. And I don't think we're going to see 10% very often, but we're going to see more variability in inflation. Many countries now are saying that inflation won't get back to target until the end of 2025. That'll be 4 years of inflation above target. the cumulative deviation, the price level of those 4 years is very large. And if we push, or if central banks allow that timeline to be pushed out even further into 26, I think the community will rightly say, are they serious? And that'll be a problem if they do. So I think the central banks have to be able to convince people that inflation will return to target fairly soon. If they don't, then the next time inflation is going to be moved away from target, and there'll be plenty of examples of it, that people won't believe that it'll come back, and that'll make the lives much harder. So I hope that most central banks have done enough, but I'm worried that they haven't, and it's doubly important that we pass this first inflation test. I still see plenty of upside risks to inflation. Labour markets are still pretty resilient. Unit labour cost growth in many countries is not consistent with the inflation target, partly because of weak productivity growth. So the wage system has to adjust to weaker productivity growth. It doesn't. If it doesn't, that means more inflation. And populations have become very upset at the cost of living pressures. I'm seeing in a lot of countries, governments say, well, that's very difficult, and let me help you out. That tends to add to inflation as well. So there's still plenty of risk, but it's doubly important that no matter what mandate you have, that we pass this inflation test, the first test of this war where inflation moves around a lot more than kind of 0.5 to 1%, which is what we used to worry about. Now we're worrying about 3 or 4% movements. Thank you.
Thank you very much. I think on price stability and financial stability, we can carry on. I mean, there's so much to discuss. But I would like actually to tackle another issue, which may be of interest to our audience and to the panel, before opening it up for question and answers. And that is to do with geopolitics and the global financial system, particularly the international monetary system. Jacob, where are we heading there? I mean, there's been a bit of rollback of globalization in terms of trade, but in finance as well. There were comments about, particular jurisdictions being uninvestable. There were reshoring of listings of one sort or another. There's this rollback that is that geopolitics has caused, and at the same time, I can say this because 20 years ago I started the internationalization of the renminbi. It's gone slower than I had hoped, but it is going to be a significant currency, playing a significant role in the international monetary system. And also last night, we heard from Zhou Xiaochuan, Governor Zhao, mentioning the SDR 2 or 3 times, and also introduce a term called synthetic currency for the world as a whole, to serve as the medium of international transaction, international exchange, and international store of wealth. Are we heading in that direction, Jakob?
Well, that's a very, very big question, indeed. It has to do with the interrelationships between markets, it has to do with spillovers, it has to do with externalities, and it has to do with the fact that the political jurisdiction of government differs from the domain over which those government's policies have an impact on. So if there was a time when we said that when the US sneezes, Europe catches pneumonia, and how do we ensure that there is a system? This was the raison d'etre for the international policy coordination framework that was introduced in the 70s or in the 80s. But I want to remind you that there were a lot of analytical issues that were involved in this discussion. The first exercise of coordination in 1985, the so-called Plaza Accord, focused only on the exchange rates. And the G5 was sitting around the table, and by the way, only ministries of finance, no central bank governors, were sitting around the table and deciding what should be the exchange rate. And this was the only topic. And the exchange rate was the jurisdiction of treasuries. And basically, that's all. And it was a great success. It was so much of a success that the appetite grew. And 2 years later, when they met at the Louvre, they said, why don't we coordinate also fiscal and monetary policies? Just to find out that it is much easier to discuss than to implement, because fiscal policies are carried out at home, and its implications are felt abroad. So how do you go about it? So they said, in such a case, let's try more. And they decided, let's coordinate also trade policies. And then, of course, they fell on their face, and they realized that it's not going to work, because politicians and governments are elected at home. This brought to the deep debate between especially the Germans and the French about semantics, which is full of content. Namely, should we call it international policy coordination, which is the French approach? They want to coordinate everything. You go first, I go first. Or should we call it international policy cooperation, which is the German approach? And cooperation means I cannot tell you what to do, but I want to understand what you do. I want to understand your model, and you will understand my model, and then you can internalize it the way you want. Even stories were developed about it, and let me take 10 seconds for a light story. When two brothers used to drive, each one in his own car. And one of them, Sam, took his friend to the ride. And when they arrived to the stop sign, there was a red light, and Sam crossed the red line. And the friend asked him, why are you crossing? It's red. He says, well, you know, my brother may come from the other side. All right, they came, then they arrived to the green light. And he stopped. Why don't you go on? Because my brother may come from the other side. And the lesson is, you don't need all to drive according to the same rules, as long as you know what your brother does. And this is very key. So I think that by now, oh, this was a delayed reaction. I think the interpreters had its own pace. You see, there are legs, and monetary policy has long and variable legs.
The international monetary system.
Yes. Yeah. So coming to the international monetary system, I think that mechanisms like the BIS, and I must say, are working much better than the mechanisms impacting on policies. They're like, I don't want to speak about the UN, but I can speak about let's talk about the IMF even. Because, no, it's not a criticism, it's the reality. The reality is that you cannot, the IMF, and we were there, some of us, even in parts, positions of leadership, Article 4, which is the mechanism by which you convey other countries your assessment and how you should do, if the other countries are small, they will need to do what you tell them. If they are large, you cannot have an impact. And the US, nobody will tell it what to do with the budget deficit. But so the system is not a place where you provide instructions and the other follow, but rather where you create norms. The problems that have happened during the past decade is that these norms themselves are not agreed upon. With the collapse of the so-called Washington Consensus, the way in which professionals believe the model, the system works, there is no convergence anymore. The very fact that we have had a big debate about conventional and unconventional, when to exit, what will be the long-term implications, what's the role of central bank independence, all of that reflects fundamental disagreements, not only about how the world works, but also what is the role of the contract between citizens and its governments, who can say what to whom and what's the effectiveness of it. It sounds like 30,000 feet, but I think it's really fundamental. Let me make one footnote to what Zeti said. It was very profound. when Zeti explained that the 2008, not global, but great financial crisis did not impact Asia in the same way as they impacted others, one of the reasons is that Asia was lucky to have had its crisis in 1997. And the lessons were drawn for increased resilience. And that's basically the point that Zeti was trying to make, and profoundly so. Thank you.
I really don't know how to interpret your answer to my very simple question as to the future of the international monetary system. Now, let me ask my other panel members, are we moving towards a multipolar system in which the, the dominance of the US dollar would fall, or even to a bifurcated framework where there are only two poles in that international monetary system? Or are we, like Governor suggested, likely to come up with a synthetic currency for use in the settlement of international transactions and the store of wealth? Philip?
Excuse me, just a footnote. No, seriously speaking, about the changing environment and why it's not so simple to answer your question. When we met first during the Asian crisis and shortly before, you were speaking about the prospects of creating an AMF, Asian Monetary Fund. Where is it now? So it's not that something failed, but circumstances changed so much that creating a rigid system around changing circumstances is a recipe for tension.
Okay, thank you. Philip?
Joseph, there's no doubt in my mind that we have a much more fragmented world. I think it's important to state this is not the end of globalization. If you look at trade flows, FDIs, or any other globalization indicator, you can see that basically globalization kind of plateaued in 2008, stayed more or less steady until Trump came, and since then there's been a kind of rewiring of globalization towards a more fragmented world. Does that lead to multiple reserve currencies, to a complete new monetary order? I think we're a long way from that, but as a general trend, this is where we're headed. It also looks, at least from today's perspective, these changes are pretty persistent, and they are, of course, one of what I would say the three major constraining factors on the global production capacity. Phil mentioned, all of this. This is what leads to more volatility on inflation. This is what leads to bigger trade-offs for central bankers. This is what leads to lower trend growth in terms of GDP. It's basically fragmentation, it's aging, and it's probably the climate transition. Now, I think, not to get too pessimistic here, this new system involves costs. One would hope that over time, this shift from sort of efficiency to resilience, which is what this is really all about, leads policymakers, politicians in particular, over time to reassess, is the added resilience worth the economic cost? And so one can hope that there is some recalibration in the system at some point, and maybe we've gone too far towards efficiency during the Great Moderation. But I would argue that there's a real risk that we go too far towards fragmentation, particularly when I think of Chinese-US relations. China has just seen for the first time negative FDI flows. How long do you keep up this kind of mutual pressure, and how much economic cost do you accept in return? If you look at the recent summit in San Francisco, perhaps that gives you some hope that this trade-off is beginning to be recognized, and perhaps we want to recalibrate a bit. So time will tell how far down this road we will go towards a fragmented world. One thing I'm sure about this, these costs are not to be underappreciated. And again, it seems to me that at some point we're going to calibrate back the other way to make sure we don't sacrifice too much in terms of prosperity, efficiency, in order to have this sort of fragmented world that allows for a lot of protectionism. I think we're a long way away from a completely sort of fractured world with multiple reserve currencies.
Thank you very much. Phil, would you like to add a few
I agree very much what Philip was saying, but I just pose the question is, why is the US dollar still the dominant global currency? I think the answer is it's easy to transact in US dollars. People can buy and sell US dollars without restriction. The markets are deep and liquid. The transaction costs are low. The property rights are secure. And the hedging markets are deep and liquid. That's why the US dollar remains dominant. If other currencies can generate those same characteristics over time, then I think they can sit in parallel with the US dollars. But if they can't, then I think it's not likely that private markets will want to use other currencies in the same way that they want to use the US dollar. So property rights, deep and liquid markets, ability to transact without restrictions. If those things don't exist, then I think the markets are not going to develop, and the US dollar will retain its dominance. I think we'll be better off if other currencies have those characteristics, but that's not the situation we're in at the moment.
Shilagawa-san, any comment?
I have nothing to add to what Phil just said. But Joseph's question boils down to how central bank could improve the functioning of international monetary system. And in this respect, there are several dimensions. One is how central bank should act as a lender of last resort when crisis should come. And in this respect, I still vividly remember how central banks responded to the collapse of Lehman Brothers in the fall of 2008. And when crisis should come, what is most important is determined and shared will to save financial system. And in the area, what I'd like to emphasize in normal condition is the effort of central banks at improving payment and settlement system. And this is rather low-hanging fruit. And the central bank should make every effort like they are now doing. And in terms of monetary policy, Jacob said, I'm not a big fan of the policy coordination as such. I'm a fan of central bank cooperation, but especially the cooperation is needed given that the financial market is so much globalized. But cooperation is easier said than done. And but what we have to realistically hope for is informed discussion at finding enlightened self-interest. And I remember the BIS global meeting in Basel when I was a governor, and the chairman always said the almost 90% of world GDP is produced by members of global economic meeting. And so even though it is difficult to internalize spillover and spillback effect of key currency country, still informed discussion is quite important. So we cannot think of a magical solution to achieve ideal international monetary system. Yeah, that is my response.
Thank you very much, Gawa-san. Dr. Sethi, would you like to add anything?
These changes in configuration of how it will turn out in the international monetary system will take years. And for the emerging world, we have to take it as a given. And that is why I go back to the point that the important thing for us is to build our resilience. So, and also our agility, which means economic flexibility, which it is to our advantage in the emerging world, because very often in the developed world, they are matured economies, and therefore it's more rigid. They don't have the flexibility to adjust. Whereas for the emerging world, we have that element and ability to adjust to changing conditions, whether it's productivity, innovation, and all the other that the panel has mentioned. And because of that and our relative resilience, we have the potential to survive it.
Thank you very much. Now, we're running out of time, and I think we should have time for questions from the floor. Anybody would like to ask a question of this panel? Please. Oh, Hans Gamberg.
Thank you. Central banks are asked to do more and more things. For instance, dealing with climate risk, dealing with inequality, and perhaps many other things that are not sort of core mandates. Is that a threat to independence, or do central banks have to take on these additional items in order to remain relevant and therefore gain independence from the political authorities?
Who would like to take that question?
Hans, maybe this is slightly provocative, but I would say perhaps some of this was a result of, again, this great moderation period where the main objective came almost automatically. And it's not surprising to me that as you saw the inflation challenge suddenly hitting back, both in terms of this immediate spike, but also in terms of some of the longer term challenges that Phil mentioned, there does seem to be a kind of refocusing on the core mandate. And I think that's a healthy kind of correction, especially if you're right, or if we're both right, and this remains kind of a persistent challenge to keep, inflation expectation anchored, then you really want to focus your main efforts on your main mandate. And I suspect, that's what we're seeing at the moment, a sort of refocusing on the key issues that really central banks are tasked to achieve.
Oh, Phil, and then Jacob. Phil first.
I mean, central banks have a really hard job. I think it's going to be hard to maintain price stability. It's hard to have maximum employment, and financial stability is hard. I don't think they need extra objectives, including climate change and income inequality. And I worry that if we take on those extra things, then it diverts our attention and actually will bring ultimately more political criticism, because we can't do very much about climate change in the end. And in the end, we can't do very much on a sustainable basis about income inequality. So I think let's stick to our core mandates: price stability, financial stability, and full employment. That's big enough job.
Thank you. Jacob, and then Shiragawa.
The criterion should be, don't take responsibility for things that you cannot affect. Simple like that. So the criterion is not, let me take over as a good citizen with the thinking broadly for the country, what are the important challenges for the country? Because if you cannot really contribute significantly, primarily to this objective, you will be held responsible without having the ability to do so. So I think it is, it sounds like bureaucratic, but you cannot kill more than 3 birds with 1 bullet.
Shiragawa.
Yeah, I believe central banks should focus on core mandate of price stability and financial stability. And we should reflect on why central banks are now being called on to contribute to do many things. And that is partly related to the central bank's activism itself. Up until global financial crisis, the size of central bank balance sheet to GDP is quite small. And now the size of central bank balance sheet is so huge. Given this huge size, of course, it is quite natural how central banks should behave in portfolio affect the resource allocation. And the same is true for prolonged monetary easing. If monetary easing is prolonged, then its effect on income and the wealth distribution is huge. It therefore interferes with the income the distribution issue. So In a sense, the call for central bank to do many things is partly the own making of central bank. So we have to think about whether or not central bank activism on the part of monetary policy is really good from long-run perspective. That is my response.
Thank you. Thank you very much. I think that more and more responsibilities are being put onto the central banks from the politicians, simply because the central banks have performed actually quite well over the past 30 years or so, handling the two financial crises. And governments have not been able to handle these issues themselves on the fiscal side. And if there are political brownies that can be gained from, tackling climate and inequality, and if there is an institution over there that can actually help deliver these objectives, then political pressure would be put onto the central bank. But I agree with the panel that we, as central bankers, should resist this. We should focus on our core mandates. Seti, have you got anything to add?
Yes, you have summed it up, Joseph, exactly. And yes, we should focus on our core mandates, but from time to time, if we are called upon to deal with certain areas and issues, it can be done, but there has to be very great clarity in the outcomes that are supposed to be achieved so that the accountability for it is there, and then the governance arrangements, and then the exit from it. In other words, a boundary management by the central bank in this whole process, so that we are not seen to be oblivious of everything that's happening, and just because we have to focus on our core mandate. And especially this is true in the emerging economy central banks, because all the best talents are really with them. And so this is the reason for it. Yes.
Thank you very much. We're overrun by about 5 minutes. I don't want to, summarize or whatever, except, of course, asking everybody to give a warm applause to our distinguished panel. Thank you very much.
Thank you very much to Joseph Yam and all our panelists. Can I ask you all to come to the front, squeeze in, because there are 6 of you, for a group photo. We'll have a photo from our official photographer and then one for our media photographers. Media photographers at the back. Great, thank you so much. Thank you. Thank you. It's wonderful to hear those stories from our very experienced panel of central bankers. Now time to look into the future. So as we've mentioned, over the past quarter century since the Asian financial crisis in 1997, Asian economies have grown substantially. They've become a major driver of global growth. And the region's financial landscape has also been transformed, in part by the advent of the digital era. So looking ahead, what are the key challenges and opportunities for Asia's economic growth? With emerging technologies and the challenges posed by climate transition, how can financial institutions continue to evolve to better finance the region's long-term growth and transformation? I'd like to invite our moderator on stage, Mr. Zhang Tao, Chief Representative for Asia and the Pacific, BIS, as well as the following panelists: Filippo Gori, CEO Asia Pacific, JP Morgan; Eric Jing, Chairman and CEO Ant Group; Amy Low, Chairman of Global Wealth Management Asia, Co-Head Wealth Management Asia Pacific, UBS Global Wealth Management Head and Chief Executive, UBS Hong Kong; and Surendra Rosha, Co-Chief Executive Asia Pacific, the Hong Kong and Shanghai Banking Corporation. And I'll hand over to our panel. Please give them a big welcome.
Okay, thank you. And good afternoon, colleagues and friends, and welcome to the fourth and the final session of this conference. So we have heard from central bank governors in the previous three panels on inflation, growth, future monetary systems, and central banking. And of course, let alone central banking in the past 30 years just now. Now we're going to switch gear a little bit to hear from the market and private sector executives on how they're going to see the future of Asia and what can we do or can they do to ensure a more inclusive and prosperous Asia in the years ahead. So we have, of course, a fantastic panel with us on these sessions. And of course, all of them need no introductions, but for the sake of the formalities, please bear with me to have a quick round of the short introductions for each of the panelists. Of course, immediately to my left is Filippo Gori, CEO of JP Morgan Asia Pacific. Philip's left is Eric Jing. Eric Jing is the chairman and CEO of Ant, the great Ant Group, not small Ant. And on Eric's left is Amy Low. Amy is heading UBS Hong Kong and in charge of wealth management for UBS and UBS in Pacific, in Asia and Pacific. And of course, the further left and is Surendra Rosha. Surendra is the co-CEO for HSBC in Asia and Pacific. So these are our panelists. In the next about 60 minutes, I will first, of course, ask the panelists to say a few words about what they see, the opportunities and challenges for Asia in the years ahead. And of course, then I will pose a few questions for each of them. And before I turn into the floor questions and answers, and finally, I will conclude by asking the finalists to share with us their final thoughts. So without further ado, let me start with Filippo. So Filippo, what are some of the key challenges, opportunities you see for Asia's economic growth in the years ahead? You have 5 minutes.
Thank you very much. So I feel almost speechless, no? After coming on the stage after a panel like the one we just had with so much history and wisdom and everything else. Anything we're going to say on this panel might not be so attractive or exciting as we just heard. But let me try to put some thoughts into this. Asia, opportunities and challenges. First of all, Asia, it's a fantastic region for JP Morgan. We have been here for just over 150 years. We celebrated 100 years in China 2 years ago, and we are preparing to celebrate 100 years in Hong Kong next year. It's roughly a third of our global workforce is actually housed in this part of the world. And it's providing the firm with an incredible, diverse, talent pool that gives an enormous leverage to the global organization. We offer the normal full suite of products that we have elsewhere in the world, with the exception of retail. and therefore we operate in Asia as we would operate in any other country around the planet. In my mind, there are three main themes that I would like to highlight in this short conversation. Number one, starting with the obvious one, the geopolitical winds have been blowing now for quite some time. Maybe they have abated a little bit in the last couple of weeks, but the long-term impact is still not necessarily fully understood. But the impact on trade and financial services is actually much more nuanced. And what I mean by this, Asia has definitely been the huge beneficiary from globalization. And we could make the argument that Asia has also been the beneficiary from an FDI standpoint of the fact that for the past 15 years, largely the Western world had an almost zero-rate scenario for almost 15 years. Nevertheless, let's look at the facts. The GDP has grown 4 times in the last 2 decades, and Asia represents now 1/3 of the global trade, which, by the way, global trade and services peaked last year at almost 65 trillion, notwithstanding the geopolitical headwinds. And the region is not only a China story, there is also India, which could become a 5 trillion economy by 2026. And you could see, therefore, in the near future, let's say by the end of this decade, the 50% of the global GDP is produced in this part of the world. And you could well have the second, the third, and the fourth largest economies in the world in Asia Pacific. Now, it is clear that the geopolitical headwinds are creating or potentially pushing some fragmentation in the supply chain, some disruption, and so on and so forth. But it's also difficult to think that supply chain that has been working for the past 2 decades very well might be completely changed overnight. I was talking to a CEO of a European company a couple of weeks ago that indicated there is no such a thing as a China +1 strategy. Maybe there is a China +N strategy, whereby a variety of countries will get some pieces of the supply chain and the whole concept of nearshoring, onshoring, and so on. Another topic that for us is important is the rise of the innovation economy. Asia Pacific has a population that is very young, it's digitally native. Eric can talk about it much better than me, and therefore the opportunities that we see in this part of the world to rethink about financial services, in particular in the payments business, which is now relying on structures that have been there for 50 years, it's primed. And we heard this morning around at this panel with Ravi Menon and company around the opportunities that are actually coming, CBDCs and everything else. Finally, the last point I would like to make, it's an opportunity, but it's also a challenge, it's climate transition. Climate transition in the sense that Asia Pacific represents 45% of the global greenhouses emission, with 3 of the top 5 emitters. We as a firm have a $2.5 trillion green financing target by the end of this decade, and we have created a Center for Carbon Transition to help us help ourselves and advise our clients on how we can meet certain targets. Now, Asia Pacific can actually, in my opinion, lead part of the transition from the brown economy to the green economy, because in certain sectors there is absolute dominance of this part of the world. Think about EVs, batteries, solar panel, and so on and so forth. And if it's true that some of the expectation that the size of the EV sales by the end of this decade will approach $50 trillion, you can see how this can be a challenge, but can also be an opportunity for the region. Let me stop here.
Great, thank you, Filippo. So much hopeful. You mentioned, financial innovations. Let me turn to Eric. Same question to you, but particularly on the financial innovations. Please, 5 minutes.
Okay, thank you for having me. I'm very honored to be here today. And SME, plays a very critical role in terms of for a more resilient economy across the world. SMEs has always been our passion and commitment. That's why we call ant small ant. We're always trying to see from SME perspectives what the pain points they have, how we can using technology to help them out. So in China mainland, we have been able to providing unsecured financing to more than 50 million SMEs across China cumulatively in the last 7 to 8 years, with the guidance from regulator and also the partnership with other friends and companies. And globally, internationally, we are also kind of sharing this, exchange the experience and know-hows and credit tech with our partners across the region. But one of the new booming trend we are looking at for SMEs is there a lot of, with the digitalization, a lot of SMEs right now participating in a cross-border trade. So according to third-party statistics, for the year 2021, cross-border B2C e-commerce is recorded about $785 billion US. Year-on-year growth more than 20%, and is still projected to grow at that speed for the next few years or even longer. So that's, for example, SMEs through Tmall International selling to China consumers, or through the Amazon to European or to US market, or through Mercado Libre to reaching Latin American consumers. But then the challenge for them is that they have to do their payment collection from different platforms across different regions, across different currencies, right? Then also foreign exchange management and also the payout management. So it's a lot of challenges. So we have been using technology to help them. So using a lot of AI for their treasury management and risk management or their foreign exchange management by partner with JP Morgan or with HSBC, other partners here. But we're still seeing a lot of challenges for them. We are also kind of right now piloting, actually in Hong Kong, with their regulated guidance and in the via sandbox kind of mechanisms. So seeing whether we can use through the tokenized deposit, right, to further enhance efficiency. Because even previously, not through DLT, it's still information layer and settlement layer is two different things, right? You can information layer got there, but settlement take a few days. If you want to settle instantly, you have to rely on liquidity provided by the banks. But if with the new kind of the tokenized deposit or CBDC type of things, so you can settle it instantly. So then we can through that, we can bring down the cost of international kind of settlement to really real time, always on module. Right now it's only available for working days, right? Your normal settlement, the transaction time is 2 to 5 days. So that's something we can average. So we are very excited to see that the central banks, Hong Kong, many other central banks are introducing CBDC or pilot tokenized deposits, the type of things. We are very, very much looking forward to partner on that. Because we are kind of based on that infrastructure, we can providing more commercial product solutions, right, to really bring the solution to the millions of SMEs across the world. So that's number one on the payment side, a lot of synergy by private and public sector to collaborate to benefit SMEs, to help them to do more international business. The second part is lack of trust. That's another issue is, for them is the lack of trust. Right now, still rely on the net of credit to kind of address the trust issue. That's cost very high. So we are thinking with the DLT, blockchain DLT technology, with the kind of privacy preserving computing, can we providing universal, international, global digital identity or credentials to help them easily can do business globally, right? To making the know your business journey or know each other journey much seamless, much easier, right? Either maybe for them to open a shop on the platforms or for them to get financing, get access to the trade finance as well. So we are also launching that product of this kind of product only of last year. We call it Global Voyage. So through one click on our platforms, so we can help SMEs submit those credentials to the e-marketplaces. Right now, already 28 global top e-marketplaces already we have partnership. So just through click right now, SMEs can have a shop opening on that marketplaces in less than 3 days. So further with the VPI integration, only in less than 4 hours. So making that life much easier. So that's something we are looking at. SME is really, really very important for the resilience. So we wish to have another partnership with our friends and our ecosystem partners across the world. So that's my, let me stop here. Thank you.
Thank you, Eric. So even a small ant can generate huge wealth. So now, Amy, your perspectives from the wealth management perspective.
First of all, thank you so much for having me. Asia Pacific continues to be a very, very important growth region for UBS. Actually, we are also celebrating our 60th anniversary next year in Hong Kong and in Asia Pacific. And if we look at the challenges for Asia Pacific, despite the fact that if you look, Asia Pacific is contributing a significant percentage of the global GDP, 40+%. Obviously, it's increasing, shaping the global landscape, but at the same time, it's also exposing to the geopolitical kind of risks. And number one concern from our client, both institutional and also the wealth client, and also in the industry survey, is geopolitical. The challenge, the war in Ukraine, the Israel kind of situation, and also the presidential election in both US and Taiwan. So that's actually has been named as one of the top risks among our clients. And then the second one is also the high rate for longer. Because with the high rate for longer, what we have seen is tighter credit. That also results in higher borrowing costs, and we have actually witnessed significant deleveraging. And that hurt, in a way, the corporate profitability and also the investment incentive. I was actually talking to one of the corporate this morning, the CEO, and looking at the rate at current level, he said it's 5 times, 6 times higher within a quite short period of time. So the investment incentive has also been reduced. And that also dampened the consumption. And the FDI investment into Asia has also been affected. And so that's also the macro. So when we had the discussion yesterday at the BIS meeting, we said higher for even longer. That's going to be very, very challenging, rather than high for longer. And so that also has been one of the another top concern among all the clients as a big challenge. And then the third one, I would say, again, talking to our client, is the poverty. If you look at around the world, the level of poverty and the widening of the income gap stay at very high level. So again, that also has been one of the discussion among both the institutional client and also the wealth client. What can they do? And that's a kind of challenge. And last but not the least, on the challenge list, I would also echo what Filippo said earlier. It's also the decarbonization. So the challenge is how are we going to reduce the carbon emission, at the same time facing also the surging kind of energy demand in the midst of some of this kind of growth in different parts of the world in terms of the industry. Having said that, we are still optimistic about Asia, otherwise we will not continue to grow out here. The commitment definitely is in Asia. Why? Because if we look at In terms of the domestic saving rate, Asia has the highest among all. Okay, and if you look at also the wealth creation, again, Asia has the highest number of high net worth individuals outside of the US as a region. And even when China slowed down, according to the Uren report, the number of ultra high net worth and high net worth individuals, the growth percentage is still single digit in 2022. And also, we just announced our third quarter result. And if our third quarter result, we have recorded a net new money of $22 billion. And more than half is from Asia Pacific. Asia Pacific contributed $13 billion. So that also speaks for itself, the wealth creation and also the growth opportunity in terms of, for example, in the wealth side and asset management. And then, while earlier we said way higher for longer is a challenge, yesterday we also discussed we expect rate cut, and that will certainly help the FDI investment because we expect, actually we forecast the FDI investment flowing to Asia, 15 to 20 billion in the next 4 quarters, if that happens. Okay, and that certainly will help the kind of a consumption, and also with the rates really turning around, with the peaking of the dollar, what we've been discussing with the client is also potentially that will help the Asian currency and the Asian bond and equity. Okay, so I think these are also some of the positive. On top, obviously, the technology innovation in Asia, I won't say too much with Eric as the expert here. It's a lot of, now we have seen some of this kind of innovation also coming from Asia, and that also potentially driving the kind of growth, and also with the green transition here. So maybe I stop here.
Thank you, Amy. So Surendra, so higher for longer or high for long is a challenge or opportunity for you?
No, it's definitely a challenge. But let me start by saying it's a challenge for our clients and therefore a challenge for us, right? But I'd just like to add on, because my panelists have covered a fair bit of the ground in terms of challenges and opportunities. We are a global international bank that where we have our Asian headquarters in Hong Kong, which is where we started in 1865. We operate in 19 markets across the region. For us, our internationalism is our strength. It's our raison d'etre, right? So if you think about the challenges of geopolitics and some of the shifts that are happening that various panels have spoken about today, it is a challenge for a global bank like us, but it's equally an opportunity in helping our customers navigate those challenges. And I think often we forget that in the context of supply chain resilience and all the other conversations that happen around China plus one or China plus N, as Filippo said, is also the fact of cost, right? I think China today versus 20 years ago is a different cost environment. And that is also driving some of the shifts that our customers are making in thinking about the next place where they manufacture. And it's the opportunity for an organization like us, with the presence across the region, with presence in other parts of the world, to really be able to advise them on those shifts. So we do see that as an opportunity, a challenge that converts into an opportunity. We spoke about innovation. You know, the technological innovation that's happened in the last 10 years in payments in Asia, for example, has enabled us to do business that we couldn't imagine doing 10 years ago. To give you an example, in India, for one of the global ride-sharing companies, every evening we pay 100,000 of their drivers their daily wages based on what our customer, which is the global company, tells us to do. We have 26 branches in India. We couldn't do that with 26 branches 10 years ago. It's because the payment infrastructure is in place today that we are able to tap into that opportunity. Today, when we have customers in China or in Malaysia who want to send their kids to Australia to study, we are able to open their accounts and hand them a credit card before they land in Sydney, for example, or Melbourne. This is possible because of technology. So I think the challenge of innovation is to be consistently looking out for opportunities where we can add value to our customers and really stay focused, because you can get into a lot of experimentation, defray a lot of cost. But really, where is the place for us to add value to our customers is really the key to the thinking. And the last bit I'll add is just on sustainability and decarbonization. I think it's for us in many ways, along with banks like JP Morgan and UBS, we've played a fundamental role in building the industrial architecture of today. Many of the entrepreneurs we've funded for generations in Asia are looking at what that shift means for them. There's going to be a significant cost to this. It's going to embed structural inflation in our economies. But I think equally, it does, as Mark Carney said recently in an article in The Economist, finance needs to go where the emissions are. And we as a collective group of banks need to do that. And I think this is where, to me, is the biggest challenge for the next 7-8 years, is how do we move from that statement to actual use cases that we can scale up and execute on.
Okay, thank you, Surendra. So we have heard the perspectives from the four panelists on the challenges, opportunities. But let me zoom in a little bit and ask them what their views on some of the particular points. We have already touched upon the high for longer. So Philip, your company has been here in Asia Pacific for the last 150 years, so it's quite long. And of course, the company and now yourself witnessed quite a big of change in terms of the landscapes of the financing, including the financing cost. So come back to the issues of, high for long. In your eyes, what has changed in terms of the financial conditions or the cost to moving forward?
So, as I mentioned earlier, Asia's been the beneficiary from globalization, and to a certain extent, Asia's been the beneficiary from a low-rate environment in the rest of the world for the past 15 years. So that you saw some of the FDIs flowing in over here. Now, some FDIs have disappeared. Part of those FDIs might have been replaced by others, and so on and so forth. Now, if, as Amy said, if the markets are priced into perfection, and therefore next year there's going to be rates cuts and the trend will reverse, then part of the issue of the high for long might not be there because it hasn't yet really felt through, broadly speaking, through the economies. On the other hand, if it's not so much how high now the problem, but is how long rates will be higher, then Asia could face Asia, as the rest of the world, would face some headwinds. And some of the things that we've spoken about over here, including decarbonization, have a component of generating a structural component of inflation in the system. So like Mr. Hildebrand said earlier in his panel, there is a high likelihood that in the future we might be facing an environment where monetary policy might be more restrictive than we have seen so far. If we look at Asia specifically, inflation has been generically more benign than in the rest of the world. Clearly, the mainland doesn't even have an inflation problem. And overall, the balance sheet of the Asian central banks is much less, is in terms of size, is much smaller than the Western central bank. So there is more firepower on this part of the world. In general, corporates have been relatively cautious, and therefore, with innovation, with efficiency, and so on and so forth, the region will drive through the next few years, assuming that that the expectation on rates are roughly correct.
Okay, thank you, Philippa. Eric, a moment ago you mentioned SME and trust. So your company, of course, is engaging with this business using new technologies, of course, using the data. So the question for you is, as we have seen in some of the Asian economies, including China and India and others, people are taking this advantage to leapfrog the move ahead compared with their more sort of economic advanced counterparts in terms of reducing the digital divide and enhancing the financial inclusions. So in your company, what you are doing and how would you assess these measures you have taken to enhance the financial inclusions in particular?
So thank you for your question. Maybe just share a case of the tokenization of real world assets. People are talking about tokenization. Maybe we share a real business case which we are doing. There's a company, they call the lift platform equipment, the leasing company. So we've been able to, we put a DLT blockchain module embedded in a chip and put into the control box of the machine. Then you turn on the machine, so all the data is on the blockchain. So through the tokenization of these real world assets, it's really creating the multiple party collaborate seamlessly on that. For example, with that, so the institutional investor very comfortably know, because when you turn on the machine, you know exactly where the equipment, what's the different working types the machine is doing, how many working hours is the machine is engaging, right? So and they comfortably figuring out what's the ROI for that. So institutional investors, they are being very comfortable to invest in the machine. There's a leasing company transforming into assets-not module. They just in charge of the operations. The insurance company also come in because based on the data, they're being able to launch UBI, usage-based insurance. So then we as a tech platforms, so we are 4 parties working together, seamless on that. We really kind of enhancing the efficiency of the economy by the whole value chain across the industry work seamless together. Further, on top of that, we've been able to bring in CBDC with smart contract. So once, for example, the leasing, the revenue come in from the leasing, right? They automatically can settle, distribute, allocate to all the investor and the operation party, and also the pay for the insurance, and also the tech provider. That's the case we are doing. Not only in the tokenization for this typical type of equipment, but we're also using that to tokenize the distributed rooftop solar, or the EV battery. Although we are also discussing with HKMA regarding tokenization of their two-wheel, the electric bicycle as well. That's a lot of popular things, in China market. They share the electric bicycles as well. So that's a lot of things happening. We are seeing that huge potential with that new technology, greatly enhance the enabling multiple parties collaborate very seamless together and drive overall the efficiency for the economy. That's one thing that's happening. We are seeing very interesting, and we are talking to partners whether we can further expand that.
Thank you. Thank you, Eric. So, Amy, you just mentioned that Asia has a great deal of the wealth, and that's true. And of course, this region does boast the largest amount of reserves. And at the same time, the region also facing a big financing gap. Just quote the figures prepared by ADB, Asian Development Bank, which said the regions need $1.7 trillion annually by 2030 to maintain adequate economic growth, battle poverty, and mitigate the climate risk, as you mentioned earlier on. So at the same time, we are facing the rising interest rate, possibly for longer, like it or not. I believe all the governors within this room can witness on that. So we are seeing the market may face the volatilities. So as a sort of if I coming to you for advice as a countries or jurisdictions, how would you advise me to allocate my reserves so that the people of the countries or the jurisdictions would be benefit more? Please.
There are so many experts. I won't say I can give you better advice than all of the experts sitting here. But actually, managing 5 trillion assets globally for UBS, and we have also been sharing a lot of the endowment style kind of investing, aiming for longer return. So basically, what we said is diversification. It's having a diversified portfolio across the different asset classes is important in order to really be able to shelter a lot of the volatility there. And obviously, the traditional asset classes like the bond, equity, in that endowment style investing is still a big portion. And what we've been advising is stay with the quality, both on the bond, investment bond, and also on the equity side with positive saving and also the strong kind of balance sheet. That's important. And in addition, what we've been observing, talking to a lot of these institutional and also global family offices, it's also important to look at diversification to some of the alternative, especially in the midst of the inflation, higher interest rate. One asset class that stands out is also real estate, because that offers also real adjustable kind of return longer run. Okay, and the other asset class that's important is also commodity, especially addressing right now the geopolitical situation, like gold and also some of the hard currency to hedge your portfolio and create the liquidity. As a matter of fact, we've been seeing also increasing demand for gold, to the extent some even ask us to set up the gold vault in different locations for them. So as a kind of hedging to the geopolitical kind of situation. And now more and more, we've been seeing clients also looking at diversification across the different jurisdictions, geographically. And again, then we will be looking at, again, those countries with positive kind of saving rate, positive current account deficit. I think in Asia we have a lot, like Korea, Japan, China, Taiwan, Hong Kong, and Singapore. And so I think that's also in board, the kind of diversification. At the same time, if I may also give advice, especially now earlier in the previous panel, we also talk about the global problem, like the inequality and also some of these issues. I think what the central bank or the government can do is also to implement some of the policy that will attract, for example, some of the family offices. Because the family offices come, the other capital, foreign direct investment will come, and also the philanthropic capital. I think that's very important because the world's problem is too big to be solved by any single party. If you look at the philanthropic capital around the globe, even the one having the highest in the US is talking about 3%. If you look at real donation, it's talking about less than 1%. And leaving alone, talking about Asia is very, very small percentage. So, for example, if we have some of the policy to attract some of this kind of charitable foundation, and that's why a few countries also position themselves as the philanthropy hub, and that will also help some of this capital to come in, and then the private and public sector working together, and to also look at some of this kind of global issue, be it income equality or the ESG kind of issue. That's why another very common topic among our client global family offices is look at collective philanthropy. In the past, they want to do it on their own, but now, if we can join hands together, we can make the world a better place. So that's also maybe the other part of the investment I can advise on, and that will really help the society and also the country on a longer basis. Thank you.
Thank you, Amy. Surendra, you just mentioned you have quite a wide range of the services to the customers. So as a happy customers I am to the HSBC. So let me ask you questions. You have been here for many years, and particularly here in Hong Kong, and you're traveling across the regions. And so you are no stranger to the extreme weather event in Hong Kong, and of course the beyond and Asia and beyond. And of course it is very difficult for all of us to think about extreme weathers in such a beautiful weathers outside the hotel, particularly like this afternoon. But don't forget, not long ago, the Hong Kong experienced 2 typhoons graded 9 and 10, and in between black rains here in a matter of the weeks, just in September and October. So this is also true, actually, pretty much in Asia and across the world. Extreme weather events are more frequent nowadays, and everybody feels it bigger and wider in terms of the impact. So as a financial institutions like yours, what kind of steps you want to take it further to help finance the green transitions or climate transitions? I'm not asking whether or not this is a core mandate of your institution or not, but how would you do it? Thank you.
Thank you. And in this morning's paper, I was reading that some of the research done by Hong Kong universities tell us now that the events we've seen over the last few months are likely to increase in intensity in the years to come. So it's even more of a compelling issue that we need to deal with. Look, it is very much a live issue that, to paraphrase what Amy said, one institution cannot solve. And we have to really come together collectively to do this. So the way that we are approaching this is how do we catalyze ecosystems or collaboration around specific problems. So we've done a joint venture that we launched last year, for example, with Temasek, where we have ADB in as well to look at how we can bring in blended finance and crowd in institutional investment, along with bank finance, into helping transition. So the entity Pentagreen did their first transaction in Philippines recently. We are hopeful that this will start to pick up much more across Southeast Asia. We, along with 5 other banks, are involved in the Just Energy Transition Partnership with Indonesia and Vietnam and the relevant G7 governments to try and identify how we can implement the phase out of coal. Now there are 5,000 coal plants in Asia. 90% of them are less than 20 years old. They've got a long life to run. It's 1/3 of Asia's emissions. How do you solve for that particular challenge is going to be critical. We've worked with DBS to co-chair and write a paper on the managed phase out of coal. That's been out for public discussion. It's now in the final stages. We hope to publish it at COP next week. So I think there's a lot of things that we have been doing, and other institutions, including those on the panel, have been doing. And I think it's perhaps now time to bring this together in Asia around our customers. So we start to think about specifically, power utilities in Southeast Asia. How do we help them collectively to work? How do we work as an international bank with local banks to make a transition finance package that works for the current asset owners, for the community, for the lenders? It's not easy, but we need philanthropic capital, we need endowments, we need bank and capital markets to come together. So I think that's really the focus for us right now, is taking some of these initiatives to scalable level, working with other partners in the ecosystem.
Thanks, Rendra. So we have covered quite a bit. So now we see the challenges and as well as our opportunities, including, for example, financial stability risk, rising debt, and we probably had mentioned the aging, and also the transition, green transitions, so on and so forth. So with that, let me turn to the audience for questions. I will pick up a few questions in one go, and then revert to the panelists for answers. So questions? Yes, please, Arthur. Microphone.
Yeah, thank you. Arthur Yun from Hong Kong Monetary Authority. I would like to put the questions to bankers on stage. Not because I supervise your institutions, but really, when you were talking about the challenges, you did not specifically cover business model risk for banks. Because this morning in different panels, we actually touched upon that particular issue of business model risk for banks. So, but you did not seem to think that that is a major thing for banks in this part of the world. And then when I was thinking about business model risk, I can't help to notice the setting on stage, that the tech firm is taking center stage, bankers were squeezed out, but unfortunately BIS is totally marginalized. So my question is really to the bankers. Are you worried about business model risk in terms of the challenges posed by tech firms? That 5 years, 10 years down the road, this will be the scene that we're looking at. Of course, Eric is of course welcome to comment on that as well. You mentioned collaboration twice in your comments. Do you think the collaboration would lead to a more optimal outcomes than a displacement sort of notion? Thank you.
Thank you, Arthur. We'll try to be more proactive in the future. Any more questions from the floor? Oh, okay. Augustine, please. Microphone, here. Augustine.
Well, thank you very much for this very interesting panel. I was expecting some of you to mention one. I think for me, from my point of view, it's a huge comparative advantage in Asia. And it is a fact that the propensity to save here is very, very, very big. I think a very large world savings comes from here. If my speech was right, I hope it was right, it's at 45%. Now, of course, I come from a region where, from Latin America, where we don't have that advantage. And of course, you see corporations struggling to get financing. And this reflects both at the different degrees, large firms, but also small or medium-sized enterprises. Governments cannot have, appropriate investment pools for infrastructure and so on and so forth. So comparatively speaking, especially many of you that are global, do you see this as a key advantage in Asia? And how do you see that savings advantage can be mobilized even further than what it is done today?
Thank you, Augustine. If no more questions from the floor, let me turn back to the panelists. Can address either of the two questions or both of the questions. Amy, please.
Obviously, as I said, also one of the opportunity for Asia is the kind of saving rate. And for example, China have also the biggest saving rate among the world. And obviously, right now is the confidence level to spend. And I am hopeful because once the confidence level come back, obviously, I don't think they will go naturally in the past to housing. So that will certainly help, for example, the finance market. But the confidence level need to come back. But that will provide really the potential for the Asian economy for future growth, be it in capital market, be it in the finance market in terms of investment. And also then it also trigger more investment incentive for the corporate, and it certainly will have the kind of lingering effect. If I may also address Arthur's question, certainly the business model wake us up at night and day. And often we said the biggest meaning competitor or the challenge may not be the traditional bank. It's also people like Eric. But I won't say it's a challenge, but how are we going to work together in order to address a lot of kind of issue? It's not just the front get more business, but even middle and back. How we can leverage on technology to monitor the risks and also to do all the surveillance, do all the data analytics. So the business model is one big thing, and that's the reason why for UBS, being a traditional industry, we also venture into digital wealth management and looking at also collaboration and partnership with some of the big tech giants. And I think that's the way to go. And so certainly this is on top of our mind, in addition to some of the other trends. Because the other thing is that what we've been observing in Asia is also the demographic, the shifting of the demographic. With the aging population and the rise of the millennial and the Generation X, that cannot be serviced by the traditional kind of model and also the traditional bank like UBS. So I think that pose both as challenge and also opportunity that we need to work together, and look forward to embracing technology innovation with my partner. So definitely the business model is something that stay in our mind day and night. Thank you.
Thank you, Amy.
So to answer Augustine's question, yes, definitely. The growing sophistication of the institutional investor client base in Asia is one of the things that, in my opinion, has dominated the past decade or so. Not many people know, but the largest pension fund in the world is in Asia, and it's in Japan. And the largest pension fund industry is actually in Australia with the superannuation business. And my impression of some of those clients is that over the last decade or so, they have transformed from asset gatherers to asset managers, and they are contributing heavily, for instance, into infrastructure sector, green transition, and so on and so forth. So they are a great source of strength for this part of the world. I mean, I come from Italy, which has a great saving rate at people's side, but not the countryside. So of course I would love to have institutions like that in our own country. But yes, it's one area of strength for this part of the world. In terms of the business model change, of course, the guys in New York never don't sleep at night about it. And that's the reason why, for instance, I didn't mention it here, but we never had retail outside of the US, because Jamie Dimon doesn't think that we have a competitive advantage in doing retail outside of the US. But for the first time, we thought that technology is giving us the chance. So we launched Chase UK a year and a half ago. We bought 46% stake in a Brazilian digital bank called C6. And we have bought a stake in Viva Wallet, which is a Greek transaction payments system, because you want to diversify away as much as you can the business model, recognizing that the threat is probably coming, in our opinion, more from big tech at this point, American big tech in that context.
Well, thank you, Filippo.
Yeah,
Eric.
I also want to give a brief answer to Arthur. So as far as I know, there are both Tao, Filippo, and Amy and Russia are all based in Hong Kong. So I'm traveling from mainland. So thank you for HKMA-BIS and Hong Kong treat guests well. So put me in the middle. That's the reason why I put me in the middle. Then secondly is because I'm, kind of the digital connectivity, digital connect all the partners together to really kind of unleash the power or synergy of us to providing more service to our customers. Actually, to be very frankly, we have a lot of things working together. With any of them, we are so much kind of on our project list, one by one. So much things, because we are very close to the ecosystem, to the SMEs. We have the tech, but in terms of global banking capacity, that we don't have. There was so much we were working together. Our focus really about on the customers. So what we can do by working together, that's something we are looking at. So we are quite complementary. So that's my answer to you. Thank you.
Thank you, Eric. Surendra?
Yeah, just to build on what Felipe was talked about in terms of the savings piece, I think it's also what we see in many of the emerging markets over the last 25 years in Asia is the resilience in the system has built up because domestic savings have been channeled into the capital markets, into equities, into bonds. And that has created a far greater degree of stability when there's volatility. So when we see the sort of risk off on emerging markets, we don't see the level of sell-offs that used to happen 15 years ago happening today. And I think that's really important to recognize the strength of Asian savings there. On Arthur's question on business model risk, look, I think it's definitely something that we consider as a significant risk or a top risk, but from a slightly different perspective. It's more about data and areas around data. So whether it is cyber, whether it is the issue of emerging technologies like quantum computing, et cetera, that are coming through and how they are likely to impact us. And therefore our need to play a role in working with people who are dealing or leading in that technology space. It has to do with data nationalization that's happening in parts of Asia where there's fragmentation now and how we can move data across borders. And when we think about financial crime and such sort of areas that we need to work through typologies across markets, these are some of the challenges we are seeing in the business model. It's perhaps less to do with tech firms where I think we do collaborate quite a bit. My concern actually is that the high cost of capital is going to drive away the innovators of the last decade because it's going to become much more expensive. So we won't see the level of broad-based innovation in the wider financial ecosystem that we saw in the past, and that does concern me. Yeah.
Thank you, and thank you all. If no more questions, let me have a final round before we closing. Let me ask each of you in a line or two that although I very much wish each and every night you have a good sleep, but let me ask what keeps you up at night and what gives you hope next morning. Start with Surendra.
Look, I think it's really fraud risk and what the bad actors outside of the industry are doing and how we are able to catch them early. That's what really keeps me up at night. And I'd say the creativity and innovation level in our Asian customer base is what really excites me every morning when I wake up. Yeah.
Amy?
Again, also fraud risk or risk in general, be it geopolitical and deglobalization, and also risk management in general, that really wake me up at night.
Thank you. Eric?
I think two things. Number one, I think digital dividends should not be the rights for the big companies. It should be for every SMEs and every individual. I wish we can join hands, join efforts together, to help SMEs and for a more resilient global digital economy. That's number one. Secondly, if you want to go fast, go alone. If you want to go far, go together. That's my.
Thank you, Eric.
What keeps me up at night are late night calls from the US. Which whoever works for an American company knows what I'm talking about. But in general, it's cyber, for sure. And what's bringing enthusiasm is our people in Asia.
Thank you, thank you. That's very much true. And we all wake up in the morning, good morning Asia, good morning Hong Kong. Great, so thank you once again for the very interesting, very fruitful discussions. And of course, we certainly cover quite a bit. So I don't want to intend to summarize the discussions, but would like to invite everybody to join me to give a warm, a big round of applause to the panel.
And thank you, Zhang Tao, for moderating our discussion. Can I ask Zhang and the panelists to all come forward for a group photo, please? And hold the smiles for our media photographers who are at the back of the room. Thank you very much, ladies and gentlemen. Well, that brings us to the end of our day. I'd like to thank all of you, our audience, for joining us for the HKMA-BIS High-Level Conference. And I'd also like to take a moment to express our appreciation to all our speakers for participating and for sharing their insights, what keeps them up at night, and what makes them hopeful during the day. I've definitely learned a lot, and I hope that all of you have as well. So we hope to see you again in the near future. I hope you don't have any late night calls from New York tonight. But thank you again, and have a great day.